that embraces the opportunities of Brexit, where businesses invest, innovate, and create jobs. I understand how difficult this moment is. After the billions of pounds it cost us to combat COVID, after all the dislocation that caused, in the midst of a terrible war that must be seen successfully to its conclusions, I fully appreciate how hard things are. And I understand too that I have work to do to restore trust after all that has happened. All I can say is that I am not daunted. I know the high office I have accepted, and I hope to live up to its demands. But when the opportunity to serve comes along, you cannot question the moment, only your willingness. So I stand here before you, ready to lead our country into the future, to put your needs above politics, to reach out and build a government that represents the very best traditions of my party. Together, we can achieve incredible things. We will create a future worthy of the sacrifices so many have made, and fill tomorrow and every day thereafter with hope. Thank you.
Rishi Sunak, the British Prime Minister there. The message pretty simple. Difficult decisions to come for the UK economy. Mistakes have been made. I'm here to fix them. From New York City, for our audience worldwide on TV and radio, this is Bloomberg Surveillance with Tom Keane and Lisa Abramowitz. I'm Jonathan Ferro. TK, pretty blunt and to the point there. Tough decisions to come.
Carefully worded, I thought. You know, moving from the past to the very recent present. Twitter lit up as some of these phrases were mentioned. But I do think, John, for many people, this is the first time they've heard the Prime Minister speak.
Working to restore trust, Lisa, quote, after all that has happened.
Trying to ride on some of the goodwill that he built over the COVID era and how much they did extend some of the aid to individuals, including the furlough program. How far does that get this administration at a time of potential austerity in the face of higher heating bills and just all in higher costs?
Didn't use the word austerity,
no,
but it's there in the message, isn't it?
There it
we
is.
Will not leave it to the next generation with debt to settle. Ultimately, Lisa, they're going to go hard.
And this is the difficult thing. How do you affect an economy and optimism at a time when that's going to mean some serious declines in the economic output of this nation? Some people talking about this is the world's 6th biggest economy for now. We have heard that from economists. Well, how do you project a feeling of strength into the future?
Lizzie Burden outside number 10 Downing Street. Let's head over to Lizzie now. Lizzie, you followed that address by the British Prime Minister that went on for several minutes or so. Talk to us about the reaction in the UK so far.
Well, the reaction behind the black door was raucous applause. Really, Rishi Sunak was trying to push hard on the reset button there. He did pay tribute to Boris Johnson and Liz Truss, but brutally, very clearly, he said that under Truss, mistakes were made. And he also took a swipe at Boris Johnson, saying that now was the time for professionalism, accountability, integrity. But he still needs to draw that thread of continuity between himself and Boris Johnson, because he is riding on Johnson's mandate here. And that's why he's underscored his commitment to the manifesto from 2019. He was referring to Brexit, levelling up, the National Health Service, all the pledges that he needs to deliver on if he wants to be elected by the election in 2 years' time, January 2025 at the latest. But ultimately, as you say, it's a realistic message. That's the message that he was trying to deliver throughout his leadership campaign in the summer. This was kind of his moment to say, I told you so. He resisted the temptation until he's been stood in front of that black door. He didn't say it while Trussonomics was imploding. But now, yeah, he's going to have to make some really, really tough tough decisions, and harder yet because of the damage trust bequeathed him.
Lizzie, how important is it for Rishi Sunak not to be speaking to fellow MPs, but to the general population, for example, in 2 years' time, to actually see some programs through after such tumult with 3 prime ministers so far this year?
Well, yeah, he's got a big job on his hands. He needs to unite the party, but also the country, and in all that, it goes hand in hand with steering Britain out of this economic crisis, because, as you say, he's going to have to choose between tax rises and spending cuts, and if he goes too hard on the tax rises, he's going to alienate the Tory right, and they've put him in to number 10, so it's very difficult. And as you say as well, he's going to have to he's going to have to convince the public that he's genuinely empathetic of their situation, when he's the word that's overwhelmingly associated with Rishi Sunak, surveys show, is not that he's the youngest prime minister in over 200 years or that he's the first British Asian in office. It's the fact that he's rich. And I think that it's interesting when you contrast that with American politics, where that seemed to serve Donald Trump well. It was almost giving him credibility.
Hey, Lizzie, wonderful to hear from you. Lizzie Burden there outside number 10 Downing Street, minutes after hearing from the British Prime Minister Rishi Sunak. The message, the headline, difficult decisions to come. From New York, let's whip through the price action for you on the S&P 500. Slightly negative, we're down 1/4% on the S&P with a big day of earnings still to come. Futures are negative just a little bit. Yields are lower by 7 basis points, 417.32, and the earnings keep coming through. And I can tell you, Coca-Cola out just moments ago, raising their full-year guidance, full-year adjusted organic revenue, now looking at plus 14% to plus 15%. On the estimate had been positive 13.4%. Better numbers from Coke moments ago.
Nailed it, and this has to do with pricing persistency. Can you raise prices into inflation? Julian Emmanuel has a modeled 8.8% revenue lift, and here's Coke. Just as a quick blush, John, I'm going to say leading the way.
A revenue beat as well. Organic revenue up 16%. The estimate, Lisa, up 9.81.
And that's even including a 5 to 6% currency headwind. So it wasn't an excuse, even though they did a nod to it, which is sort of your question of, it's one thing to blame the FX issue. It's another to say that's the reason for the disappointment.
Reaffirming your outlook is as good as a beat these days, I would
100%.
suggest. GM did that as well about 15, 20 minutes ago, Lisa, and we catch up with the CEO in about an hour from now.
Yeah, that's one of the things that we're going to be watching. Just to whip through some of the other things that we're looking at today, we get a slew of economic data, including August U.S. FHFA house price index, as well as the S&P CoreLogic's 20 city index. How much do you start to see those prices roll over? And what's the bleed time, really, into the core CPI measures that we look at? 1 p.m., the U.S. is selling $42 billion of 2-year notes. Who shows up for these bond auctions? It looks attractive for some, and others say perhaps it has to go higher if we're looking at a 5% Fed funds rate for a year or more. And today, the earnings do continue after the bell. We are sort of drum beating to Microsoft and Alphabet, given that those account for such a huge proportion of the overall index. And Microsoft, I believe, John, is expected to come in with the lowest sales increase going back to 2017. So how much does that really give a guide for where we are right now?
A couple of names that will have something to say about foreign exchange, I'm sure, Tom, a little bit later this afternoon. Then the big names like Apple coming up on Thursday.
I think it's like 2-3% is sort of the typical average model, and we're clearly out over that. 4, even 6%. You may have a few that are 7 or 8% hits. That's substantial.
We get lucky this morning. John Balvan around the table with us, the head of the BlackRock Investment Institute, and formerly so much more than that. John, fantastic to catch up with you, sir. I read the weekly note from the BlackRock Investment Institute that came out just yesterday, and you talked about the significance of the midterms, and you guys don't think they're that significant for future returns over the next several months. Why?
First of all, it's so great to be here. No, we think the usual playbook for the midterm is that, you know, if you have divided government or houses, it tends to be a boost for markets. But as anything else, this time around, the usual playbooks don't apply, we think. The main story is about the foretold recession that we're going to have, we believe, in the current of the next year. And as a result, we think that this is the second sideshow, the important for the future of the country and everything, but in terms of markets, we don't think that's an important driver.
Swap lines front and center, major discussion at the meetings in Washington here a week or so ago. Give us BlackRock's estimate of how countries will have to go to the Fed given a global dollar shortage, the illiquidities that are out there, is seen in FRA OIS.
Yeah, the important thing is here we're seeing like the most rapid tightening of financial condition in a generation, in a very long time. We haven't seen really the cracks yet appear in the system. It's remarkable to see all the strengthening of the U.S. dollar you've seen without like the knock-on effect or cracks we would have seen in other circumstances. I think that creates a level of anxiety that was really clear at the IMF. A lot of conversations about how we shore up the system in that context. Swap line will be a key tool potentially in that environment. But I think so far what is really surprising is that it's been very stable despite what would otherwise.
From your academics at Princeton and your work with the Bank of Canada, if we believe it's nonlinear as we disinflate, do you think we can succeed at that with stability, or are there going to be instabilities? Witnessed with Damien Sassower yesterday, we looked at a Columbia piece going from 98 down to 63 on the price of bond. That's a crack.
I think it's very hard to see something that's going to be smooth landing in any way. That's true for the economy. That's true for the financial market in this context. That's why, we think we're on a clear path towards over-tightening of monetary policy. But it's going to be very rocky. We are underweight equities, as bearish as we've ever been, I guess, in terms of broad risk-taking at this moment. At some point, that's going to change, but the reason is really because that tightening it could be nonlinear, as you say, and we haven't seen really the crack. I think the UK we've seen over the last month is like an accelerated peak in the future, and I think that's what we need to guard against.
Jean, if you believe in a hard landing, why not buy treasuries here?
That's a great question, and that's another aspect of the current environment where the typical playbook might not be applying. We don't think it's going to apply. We are going to see a recession, but it's going to be a recession in the context where inflation won't be under control, and it's a foretold recession. It's really the recession caused by monetary policy. Really, that's the way by which inflation will get under control. And as a result, when we get to that recession, you won't see the typical reaction of yields falling and bonds playing their safety role. So the typical playbook of go find refuge in bonds in this recession, I think, won't apply.
Is this part of the reason why perhaps the stability that you talked about, the surprising resilience of markets, is almost a headwind to them because it won't necessarily stop the rising rate environment? It won't necessarily change where we are in a wholesale value. How high can yields go and stay for a prolonged period of time before something breaks in the financial system?
So in our estimates, like if we go to 5%, as now we kind of assume for early next year, this is a world where we're going to see a very significant slowdown of activity, decline in activity. So that's 2%, we think, as a minimum of GDP. It's 3 million jobs that would need to be lost in that context. So in a world where 5% is sustained, and I think in a world like this, the financial system, leveraged as it is, will start to see some response, and that's the so 5% is where we're heading. We don't think we can go much further than that. That's why over the course of the first half of next year, we're going to see central banks having forced into some pause before they can go further.
Jean, you said recession foretold. I'm interested by that phrase. You've also talked about the appropriate time horizon to bring inflation back to target. And I think you've conveyed your disappointment that central banks aren't having that discussion a whole lot more. Does it have to be this way?
I think what is very interesting, and we've written about this, is the fact that there used to be two sides to any decision in central banking. Like, it's not typically obvious what you have to do, and I think this environment is as tricky as it has ever been. I mean, I don't think there's been any so sharp trade-off that we had to deal with. We have to go back to the 70s, and the 70s was a different situation altogether. There's a tendency to apply the playbook of the 70s, but we're not in the 70s. And so this lack of two-sided debate on what's going to happen, or nuance, is troubling. And that's why we think that we are going to get over-tightening. That's not necessarily the outcome that had to be, but I think it's happening. At some point, I think the pressure, the forces will be pretty strong, and we've seen that in the UK, right? I mean, we've seen the accelerated version. You go in one direction, markets will put some pressure, and I think we'll see some forced pause. That's not great for credibility. I think it's better for central banks to be on the front foot, and I've signaled that there are some nuances here we might need to deal with, but this is not the situation we're in. So I think we're going to be forced into a wake-up call, and we'll look like a pause, but one that has been forced as opposed to being planned.
Quickly here, and I could go for an hour with you on this. There was a guy named Bernanke who emailed you when you were a kid and said, do you want to try for a PhD at Princeton? You talked about it the day he won the Nobel Prize. What did he and Anna Schwartz and Milton Friedman do so we didn't repeat a depression?
Well, I think the key lesson of the Great Depression that Anna Schwartz and Friedman at first, more from an anecdotal perspective or documenting the depression was, and that Ben Bernanke and others have more formalized, was that if you tighten monetary policy as the economy is going down, you create this financial accelerator dynamic through the banking system.
Is that what we're doing right now?
and with bank runs. And I think that was very much in his mind when 2000 came. I thought it was interesting in the speech he gave in 2002 in the anniversary of Friedman, that he said, we heard you, we won't do it again. That was referring to the depression. He thought he was abusing his status at the time, but not his future status. He was a governor, but became chairman afterwards. The thing, though, is at this time, I don't think this is the playbook. This is not the playbook for the current situation. This is not a demand-driven financial crisis, bank-run story. This is a massive supply shock that we're dealing through. I'm not sure that those lessons apply right now. So that was for 2008, not necessarily for 2020 and after.
Jean Barvan of BlackRock. Jean, fantastic to have you with us in the studio here in New York. Thank you, sir. And we're still trying to unwind some of those policies from the Bernanke years, Tom. It's amazing to see the ECB came out and had to basically come up with this new tool, TPI. Then we had the Bank of England had to step into the gilt market. We've had the BOJ that's had to intervene in FX. And South Korea, earlier this week, Tom, also had to do something on the credit side. The government had to make an announcement there too. And I just wonder, TK, as we try and step back from this era, how many more times central banks will have to step back in?
They're going to have to be very supple, and you go from Damien Sassar yesterday to Jean Boivin today, and it's extremely fluid right now, John, and I frankly think the original theories don't work here. As Dr. Boivin says, it's a supply shock.
Jean, would you like to be a central banker again? Would you fancy that?
Not really.
No, thank you.
Can you straighten out the Montreal Canadiens?
I didn't think so.
I'll leave that to others as well.
Coming up on this program, Mary Barra, the chairman and CEO of General Motors. Looking forward to that. Matt Miller's going to catch up with her in about an hour from now. From New York this morning, good morning to you all. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In the UK, Rishi Sunak has formally become Prime Minister. Sunak addressed the nation outside number 10 Downing Street after meeting with King Charles III. He said that mistakes were made by his predecessor, Liz Truss, and he promised to place economic stability and confidence at the center of his agenda. The U.S. won't change its stance toward China as a result of Xi Jinping seizing more power. Advisors are still trying to set up a meeting between President Biden and the Chinese leader. At the conclusion of the Communist Party Congress last week, Xi placed allies in top posts and paved the way for a third five-year term. NATO is increasingly concerned that Russia's desperation over battlefield failures in Ukraine may lead the Kremlin to escalate the war. And that could involve a massive attack on a target like a dam or even a weapon of mass destruction. NATO says that for now, there's no sign Moscow is actually preparing for such an attack. Adidas has ended its partnership with Ye, the rapper and designer formerly known as Kanye West. In recent weeks, Ye has made controversial statements, including anti-Semitic posts on social media. That's turned his Yeezy line of sneakers into a lightning rod for criticism. Adidas says that ending the deal would mean a negative impact of close to $250 million in net income. And UPS says it's on track to meet its financial targets for the full year. The package courier is trying to manage through a slump in peak season demand that has rattled the shipping market. UPS's third quarter earnings beat estimates. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Hello, I'm Emma Barnett, and I'm a journalist and presenter. This is my new show, Emma Barnett Meets. First, I'll be meeting Chinese artist and dissident Ai Weiwei, and I'll talk to the novelist and political scientist Elif Shafak. Tune in to watch those who shape our world explain how the world shapes us. This is Emma Barnett Meets on Bloomberg Quicktake.
The markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg. Earnings season is here.
The earnings are starting to pour in.
The numbers are holding up better than expected.
Sorry, business isn't all that bad.
Bloomberg breaks the numbers first.
Netflix earnings going across the wire.
A big beat. Stock is up more than 8%. Coming in stronger than their rivals.
With exclusive expert analysis.
Finally back to growth.
The mother of all opportunities.
What is the industry to watch?
That's where the rubber hits the road for Goldman Sachs.
It's going to be a really interesting earnings season.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
You know, they'll take a pause at one point. Conditions around the world to tighten. It's rational to take a pause because any 3 months doesn't matter that much. But American consumers, eventually the excess money they have is running out. That'll probably happen sometime mid-year next year. And then we'll know more about what's going on with oil and gas prices and all that kind of thing.
Jamie Dimon, the JP Morgan CEO, live from New York. Good morning to you. The price action looks like this going into the opening bell. Equity futures slightly negative through much of this morning. We stayed there. We're down 1/3 of 1%. Yields are lower by 7 basis points on a 10-year, 417.32 in the FX market. Euro dollar, slightly weaker euro in the mix here. Negative 0.16% on that currency pair, 98.58. I can tell you, the Italian Prime Minister used her first speech this morning, guys, to lawmakers in Italy to absolutely slam the ECB. How much of this are we going to see across Europe and across the United States as well?
Isn't the answer it's a mystery? We don't know.
For the Federal Reserve, we've seen it from Senator Sanders and Senator Warren. You imagine we'll see it a whole lot more if the economy starts to roll over and unemployment starts to
in the
climb.
elections as well.
And this is what Prime Minister Maloney had to say, Tom. The decision to raise borrowing costs, quote, is considered by many to be a rash choice, which runs the risk of impacting banking credit to families and businesses. And Lisa, she went on and she went on.
And how much of this is driven by that anger that austerity was really placed on Italy, was placed on Greece was placed on some of these nations by the ECB, by the European region, at a time when Germany is kind of front-running some of these issues. I mean, how much is that part of what's fueling some of the additional anger toward these policies?
TK, we're going to see a lot more of this, I think. I think it's fair to say.
And again, a chart, it's not my chart of the year, but close here is the measurement of the Bloomberg financial conditions in Europe is an absolute outlier. Can't say enough how restrictive their stance is, given the mathematics
Some
of those
comments
indices.
here on bond buying as well. Here's the quote for you. That is compounded by the decision already made by the central bank to end, beginning on July 1, 22, the program to buy back bonds on the open market, which creates further difficulties for member states that have elevated public debt.
Well, we will see. And of course, Thursday's ECB, right, John?
It is.
Very
Looking
good.
for
We'll do that on
75
Thursday.
from the ECB.
Yeah, well, an easy 75 is then what after that? After that is after the midterm elections. Anne-Marie Horton joins us again, our Bloomberg Washington correspondent. Anne-Marie, at the White House, and I guess the basic idea as a president yesterday giving pep talks and that. What does a president of the United States do in the next 2 weeks?
Well, he's going to do his best to try to rally Democrats to get out and vote, try to rally independents to make sure they're reaching out as well to the youth vote, which was critical in the presidential election. But also, Tom, you have to think he will only go campaign, of course, if those candidates want him alongside him. You have very different views from some of these candidates that are really running in some of these tight races and critical races, like John Fetterman in Pennsylvania has really embraced President Biden. But then, of course, you have the Democratic Senate candidate in Ohio that has wanted to keep a very large, wide distance from the president, actually looking at outreach to other members of his party, like Senator Manchin. So the president is obviously going to walk that line, but he's going to continue to tout, and he said this a few times yesterday, that the Democrats are fiscally responsible and that the Republicans want to do are MAGA trickle down. This is a line that he continues to say, and I imagine the next 14 days that'll only ramp up.
And it goes to the apathy we talked about in the last hour. What does the turnout look right now? I mean, I'm going to editorialize in the presidential election. Mr. Trump got more votes than he got the last time around, but nevertheless, there was this huge turnout for President Biden. Do you expect the same kind of dynamics again?
Well, midterms obviously have less of a turnout
Yes.
for presidential elections, but at the same time, you do have really important issues that are coming up on every single poll that may force people to want to get out to vote. And obviously, that is going to be the economy, that is inflation. We don't know what turnout will end up being until the very end. Tom, you made a great point in the last hour that do people even trust the polls? What we saw from the presidential election with former President Donald Trump, and then, of course, candidate Hillary Clinton, that the polls really got that wrong. A lot of this has to do with the fact that there is potentially a bias, that Democrats are more honest in polls, and some Republicans actually shy away. But we already have voting underway, and there should be a robust turnout. A lot of that also depends on a state of play of that election day. The weather and things like that can affect whether or not people are going to go out and actually vote.
Anne-Marie, to John's point earlier, how much is the Federal Reserve becoming part of the electoral conversation in terms of them going too fast, too far, and torpedoing the economy?
I think for us in the financial markets and the individuals we talk to, it's incredibly important. I think for everyday Americans, it's not so much the Fed, but what the Fed is doing that is impacting their everyday lives. So what does this mean for their mortgage rates? Is it actually taming inflation, having an impact on energy prices, a potential other prices going up, consumer prices like groceries and rent? But also the fact that does this mean if they're going too fast, are they going to be blaming the Fed or, like many do, blame the current administration if we do end up in a recession, which if you look at Bloomberg Economics' latest projections, it is 100%. It is basically we will be in a recession effectively at some point in the next 12 months.
AMH, down in DC, Anne-Marie, thank you. We basically heard that from Jean-Pierre Van months ago of BlackRock on this program. In this hour, 15 minutes ago, Tom? He basically said the same thing about next year. The recession is already baked in. That's what you're going to get.
Or at least a slowdown. Do we need a recession? I mean, I've always been in the camp, John, if you have 1% GDP, that's not good enough for a huge body of Americans. I don't need an NBER recession. What I have here is Dr. Boivin mentioned, is a massively restrictive set of central banks guessing into an economic slowdown.
This is their goal, to engineer the slowdown. Isn't that the problem? Politically speaking, to Lisa's question,
but the price is to debt. I mean, the Columbia piece yesterday, I'm looking at the 10-year United Kingdom piece here now, and it's basically back 13 years. I mean, it's a whole Disney. It's a whole new world.
And Lisa, there's been some big losses in this market, and to pick up on the Disney and the fairy tales, it's been Alice in Wonderland markets for a long, long time. And we're trying to step back from that, and it comes with pain.
Well, and this, to your point, Tom, you said that there's so much pain in the bond market, and yet Jean Boivin is not buying treasuries yet. He sees yields going even higher because we still have this inflationary kind of push.
5%? Are we still at a 5%
yes,
level?
Citigroup's Andrew Hollenhorst just put this out, saying that home price data is going to show you do see a decline in housing prices, but the wage data that we get on Friday could show upward pressure on inflation from wages, indicating that wage spiral. So this is the sort of push-pull of where we are in inflation right now.
Can you make the argument that we've priced in the bulk of a rate hiking cycle? If you're looking at pricing at 5%, then I guess you can probably make that argument. Can you make the argument we've priced in the consequences of that rate hiking cycle? Tom, I don't think anyone's making that argument right now.
Where else are you going to do a log recession analysis while we're talking?
Nowhere else.
Nowhere else.
You're the only guy in the world who would do that.
6 or 7 standard deviations.
Do you know how that's possible?
On UK yield.
You just ignore your colleagues.
I do. I ignore them completely.
And just build out charts.
Rishi Sunak has a 6 standard deviation 10-year gilt.
Have you told him that?
I told him that.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
What I love about business is you get to build things from nothing.
I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full-service shadow banking with nobody in charge.
Live from New York City, here's the price action this Tuesday morning. Good morning to you. Futures negative, a little more than 1/10%. No drama on the S&P. On the Nasdaq, almost unchanged, positive by about 1/10%. After the close later, close to 18%. Call it about 18% of the Nasdaq 100 reporting in just two names. Microsoft being one, Alphabet being the other. We'll look out for that a little bit later after the close. In the bond market, 2s, 10s and 30s, and TCAM with you. I'm calling it Google too. I have no idea why I just called it Alphabet. 2s, 10s and 30s look like this in a bond market. Your yield on a 2-year, 445.56. Back on Friday, we had a little look at 460, and then we backed away. Backed away on some of the Fed speak, the idea that we get this step down from 75 to 50 to 25. We heard from Jordan Rochester of Nomura, who's not looking for that step down. Nomura and the team are looking for 75 basis points from the Federal Reserve at this meeting, then 75 basis points from the Federal Reserve at the next meeting. One other thing Nomura and Jordan Rochester had to say was that at the moment for him, certain currency pairs are getting a little bit boring, and boring is welcome when you're talking about sterling. Cable is where we see a little bit of outperformance. The pound against the US dollar within G10 today, the pound right now at about 113.25. And Tom, I think we're all hoping we get boring and quickly in the gilt market after we saw a move of more than 30 basis points lower at the front end of the gilt curve yesterday on 2s, the biggest one-day move lower in about 30 years.
For Governor Bailey, John, it has improved, but the needle's barely moved. And let's be clear, the Prime Minister and his team understand those Bloomberg charts. John, we got to be sure that the Prime Minister has a Bloomberg terminal at 10 Downing Street. What he's got is 5, 6, even 7 standard deviation moves, and that's untenable. He's got to fix that.
And we've got to work out who his Chancellor is going to be. We assume it's going to be Jeremy Hunt. We've got to fill out that cabinet,
That's
Tom.
true, yes.
Then we've got to work out what the budget looks like. And then for Governor Bailey, it's over to the Governor of the Bank of England. Does he need to do a whole lot more than he had to the last time they met? And does he need to do less than he had to do, maybe, than about 2 weeks ago? Tom, a lot's changed in the UK in the last several weeks, that's for sure. Your 2-year in the UK, about 3.39. That's the cross-asset price action. Let's get you some single names. We can do that with Lisa. Hey, Lisa.
Hey, John. Is affirming full-year guidance the new beating of estimates? That's really the question that I have after some of the morning's earnings. We got UPS, we get General Motors, both affirming full-year guidance. Those stocks both popping more than 4%, nearly 5% for General Motors, 4.5% for UPS. How much have analysts, have traders downgraded some of their expectations? And Tom, you were talking about that basically affirming or just making estimates is basically akin to beating in an environment like the one that we're currently in.
Yeah, these are challenging stories. UPS, I'm not going to conflate there with 3M and GM, but they're managing the message, Lisa, every 90 days. And what our viewers and listeners do is they look at shareholder return, which has been a challenge.
Yeah, although UPS, different than FedEx, which has actually provided much more negative guidance. 3M, however, the second downgrade in terms of full-year forecast based on FX headwinds. Second downgrade this year. That is not really being received particularly well in the market, down 2.4%. But Tom, this really speaks to what we've seen more generally since the earnings have begun, which is that misses are punished and just affirming is beating. And, you know, beats aren't necessarily being rewarded if they don't have any visibility that far into the future.
Thank you, Lisa. And right now we've got visibility on foreign exchange. Joining us with really sharp notes, particularly one on yen today, George Saravelis, Global Head of FX Research at Deutsche Bank. George, I'm going to pivot on you. There's 6 ways to go here. I got to go to Thursday in the ECB meeting. What will President Lagarde do to the euro off of her decision to lift a presumed 75 beeps?
Good morning, Tom. So I think the answer is probably not much. The 75 basis points hike is widely discounted as you expected. But critically, if you look at what's been going on this year, currencies have not really been very correlated to interest rate differentials. It's been a lot more about the dollar safe haven risk premium, some of the very large geopolitical risks, whether in Russia or China. So I wouldn't really expect the ECB to have a sustained impact on the euro, which is something it has struggled to have for the last few meetings as well.
George, let's start with the growth outlook when it comes to Europe. Just how bad do you and the team expect things to get in Europe, and how quickly?
Well, it's interesting you mentioned the growth outlook, John, because if you look at the euro, it really behaves as a pro-cyclical currency. So for the euro to be strengthening, you need growth expectations to be bottoming out and then recovering. I don't think we're at that stage yet. We obviously got the PMIs just a few days ago with another downside surprise. So we do have a recession penciled in. I suspect it may not be as bad as some of the more extreme forecasts that are out there, because so far at least the weather has been quite favorable. So if you're looking at the nat gas situation, the tension there seems to be easing. But no question about it, Europe is going through a sharp slowdown, and that is definitely a big headwind for the euro.
George, given the developing trade dynamics, the structural shift in the way that energy is supplied towards Europe, do you see some kind of structurally weaker euro in the years to come relative to what we saw in the years before?
I think you can make that argument. The problem is it's impossible to fully understand where the equilibrium level of energy prices are. If you take natural gas as an example, back in August, we were essentially 3 times as high. If you plug in the energy prices at the moment in terms of what it means for the external accounts, the deficit is going to be half where it was in terms of peak. So I think there's still huge uncertainty in terms of the equilibrium level of oil and, more importantly, nat gas prices. But if they stay as elevated or go back to where they were during the August-September period, we would be talking about a structurally weaker level of the euro for sure.
Although, to build on what John was saying, we've seen a lot of turmoil in China as well. And China has a bigger play on the German economy, the biggest economy in the euro region. And we're seeing foreign flows just flood out of that nation now at a record pace. How much does that feed into this feeling that structurally the euro will be weaker and that this will lead to weaker growth in the euro region now and in 3 years from now?
Well, it's interesting that you mentioned China, because if you look at the renminbi, it's now actually weakened more than the euro has over the course of the year. And this is without facing a war in the footsteps, so to speak, or as big of a negative commodity shock. So the main point I'd make on exchange rates is the dominant driver has very much been the broad dollar, which has pushed currencies weaker relatively symmetrically, with the exception of the yen and extreme policy there. But I would say the combination of China weakness plus the commodity price issues in Europe do definitely point to more structural headwinds as far as European growth goes for the next few years.
You mentioned the yen, and you put out a note overnight that I thought was fascinating, basically saying it's broken, talking about yield curve control and talking about the whole plan that Japan is trying to stick to. Does this mean that you think we might not see some sort of massive breach, some sort of dramatic shift in policy that's just going to be a slow burn as expressed in an ongoing weakening yen, and not necessarily leading to the disruption on a global level that some people were afraid of?
It's a very interesting dynamic in Japan. In some sense, it's the biggest monetary experiment in history taking place. But if you look at the dynamics, there are a couple of things that are worth noting. The first one, as you said, is apart from those 3 bonds that the Bank of Japan is targeting, everything else is essentially decoupled. So we're no longer essentially in a yield curve control framework. We're just in a specific bond cap framework for 3 specific bonds. But everything else, if you look at swap levels in terms of swap spreads and what swap yields are implying, everything's already started to adjust. The other point is the Bank of Japan now effectively owns the entirety of those, or the near entirety of those specific bonds they're targeting. So the point is, even if the cap goes, the only institution that will face losses on those bonds are the Bank of Japan itself. So I do think it will be disruptive, but the way it's being managed and the way the market's de facto yield curve control, in any case, it may mean it's less disruptive than some of the more extreme scenarios that people are putting out.
George, I went back 40 years, and there have been 5, including this one, manufactured surges in Japan of inflation. They've been manufacturing inflation. Up we go to 3% inflation. Is there inflation now? Is Kuroda's inflation manufactured, and is it a fiction?
So far, it's been imported inflation, and very high commodity prices have helped. The very weak yen has helped. And what he's trying to do, and I think this is why people have been surprised that it's the first genuine attempt to shift the entire inflation regime higher, He's trying to make that feed into wages, into core services. And if you look at the data, it is slowly starting to work. So core services, core goods is starting to move wider. So maybe he will go down in history as the first Japanese central banker that's able to move Japan out of this low inflation equilibrium. And if that happens, I think it would be a very, very globally significant event in the sense that the last bastion of disinflation, so to speak, will have ended.
George, can I ask a stupid question? What happens when a central bank loses money?
That's a very interesting and an important question. I think the answer is fairly straightforward, at least from my perspective. Not much. So we already have the RBA, for example, running negative equity because they're losing money as the price of those bonds they bought have gone down. The Fed is essentially also losing money on its QE portfolio. But when we look at the balance sheet of a central bank, we have to remember it's very different from any sort of private sector institution because the central bank prints its own money. So yes, there are discussions around loss of potential credibility, that central banks would need to be recapitalized. But at the end of the day, these are all balance sheet technical questions. I think in practice, it doesn't really mean anything.
Hey, George, wonderful to hear from you, sir, as always. Good to catch up, mate. George Saravelis there of Deutsche Bank out of London. Isn't that a hedge fund manager's dream, TK? What happens when you lose money? Not much at all.
Yeah,
not much at all.
That's the size of the institution, and I think really at the heart of what Alan Meltzer did for years in history of the Fed. They're just that big where if they lose money, it's one big so what. I would state, and Enda Curran out with a superb article today with Tim Generando and others, worldwide on the challenges that central banks have. And I think it's critical. Again, the debt price movements I'm seeing are not normal.
I thought the perspective on Japan was really important there. I've often criticized the BOJ. They've got their head in the sand. Operation Ostrich, everyone else is hiking. They're stuck there doing nothing. I think they truly believe this is a once-in-a-lifetime opportunity to reset inflation expectations higher. And good luck to them. Let's see if this works out. Equity futures right now negative on the S&P. We're down about 0.1%, live from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Rishi Sunak has formally taken over as Prime Minister of the UK. Standing outside number 10 Downing Street, Sunak promised to fix the mistakes made by his predecessor, Liz Truss. He said the UK faces a profound economic crisis, and that will mean difficult decisions to come. A group of progressive House Democrats urged President Biden to seek peace talks with Russia to bring about an end to the war in Ukraine. But within hours, lawmakers backpedaled and issued a statement supporting the White House policy. The Biden administration has rejected the idea of negotiating with Russia without Ukraine's approval. Florida's Republican Governor Ron DeSantis has declined to say whether he'll run for president in 2024. In a debate, Democratic challenger Charlie Crist accused him of being too distracted by a bid for the White House. Polls show DeSantis leads Crist, a member of Congress and former governor. So far, rising interest rates haven't hit General Motors business. The automaker's third quarter profit beat estimates on record revenue. GM also reaffirmed its guidance for the year. The company's U.S. auto sales soared 24% during the three-month period. And General Electric cut its full-year profit target despite strong cash performance in the third quarter. High costs in the struggling wind operations added to the ongoing challenges with labor and the supply chain. GE's renewable energy division saw operating losses balloon to $934 million in the last quarter. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How do Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
I think the thing people really need to focus on the most is how long does the Fed keep that funds rate really high? So let's say up to 5%. We think it's going to be a long time, 6+ months, maybe a year. That's going to hurt equities, we think, and that's going to hurt risk.
That was Mike Schumacher there, the global head of macro strategy at Wells Fargo. Fantastic to catch up with him. The attention turns from fixed income to earnings a little bit later. Numbers from Alphabet and numbers from Microsoft after the close. Your market looks like this going into the opening bell, about 1 hour and 42 minutes away. Equity futures down 0.2% on the S&P. Yields heading much, much lower now, down 9 basis points, Tom. Your yield on a 10-year, 4.1522.
Watching yields and what price. Thank you for the huge response yesterday when I was going mental about price matters. It's not just about yield. Someone that knows that is Robert Tipp, Chief Investment Strategist, Head of Global Bonds at PGIM, with their really exceptional record of trying to find total return. Robert, I look at the corporate, not the full faith and credit total return, but the Bloomberg Corporate Total Return Index, and it's something in the vicinity of a drawdown of a negative 21% on price. Do you just assume with Fed action that we enjoy bond prices lower and yields higher?
I think the Fed is bringing us a gift here. I think we're having a regime shift. And I think at the Fed, the one that's really been in the lead in the cycle is Bullard. And I'm sure you remember his paper in 2016 about regime shifts. These markets, we don't slowly, go from this environment to that one, and it's a little bit different than 6 months ago, you jump. And actually, we could be jumping back to an equilibrium that's much more normal. The Fed funds rate the last 50 years has averaged 5%. And right now, everyone is convinced that if this Fed goes over 4 inches towards 5%, there's going to be a hard landing. But for your corporate bonds, if they inch over 4%, and slow down and see how things are going, there's a lot of yield out there right now in long corporate bonds. And it's a real horse race as to whether, those yields are peaking, those returns are bottoming out here.
I would have a nameless bond. This is somebody who reported earnings today. Doesn't matter who it is. And they're enjoying a 4.1% piece out 10 years. Make it 9 years. And they've also enjoyed a 30% drop in price, Robert. Tell our listeners and viewers how they handle duration if they've enjoyed double-digit losses in bonds. Do you come in short duration, or do you go out long duration to try to pick up coupon?
Well, I think we've normalized here. I think this is an environment where people are supposed to be at some kind of a strategic average position in terms of their asset allocation, and that includes duration. We have been in a period driven by central banks targeting unnaturally high inflation rates. It wasn't that long ago, 2019, even in 2020, Chair Powell was talking about 25 years of failure to get inflation up to 2%. And they had interest rates incredibly low, but now that's changed. And with COVID, with all the terrible things that have happened, one positive is they're resetting interest rates higher. And so I think that, 5-10 years from now, when we look back, inflation will be lower than it is now. Growth will probably be lower than it has been, certainly the last couple of years. And this will have been a reset. So whether exactly, 4%, 4.5%, 5%, what's going to be that peak level of rates, I don't know. But I think we're in the zone of that peak in terms of interest rates. But it's not going to be an up and all the way back down unless something unforeseen happens. This is a setup kind of like 94, 95, where rates go up, they stabilize, and that ends up boosting bond returns for the long run.
The bond returns perhaps in investment-grade corporates, as you were talking about. What about just in 10-year treasuries at a time when people are talking about normalizing at higher yields?
I think long duration, high quality, like 10-year treasuries, it's more balanced. I think that, if the Fed funds rate ends up going up to 4.25, 4.5, and the Fed at that point is saying, we're kind of indifferent here, but we need inflation to come down. And so if anything, that probably means that we may be hiking again. If that's the case, I think you're going to have a little bit of a burn on the yield curve where those long yields that are lower than the short yields are going to be under pressure to move higher, to pay people compensation to take that duration risk because of the uncertainty.
To Tom's point about price down in some of these corporate bonds that have coupons of 4% that were sold, say, a year, 2 years ago, and now have all-in yield of something like 8%, 9%, 10%, how much does that become a credit problem for these companies in a year when they have to start refinancing?
Yeah, so I think the whole dollar price, the big dollar price changes, it creates mental problems for investors in terms of figuring out the right things to do. And in terms of issuers, it creates less of a problem in the immediate future than you would imagine. So on the issuer side, to your question there, it takes a long time for corporate debt structures, cost of capital to change. The bonds mature very slowly, and they issue, and it's incremental. And if you're in a world that's going to support a 4% 10-year treasury for the long run here, that's probably a pretty high nominal growth economy, and they're going to get by. But is it going to be a plus? No, it's going to be a negative, but it's a very slow burn. The dollar price thing for investors, it's shocking, when you have a reset, like we had before from very high yields to very low yields, you get a one-time jump in dollar prices where, your bond future may be closer to 200 than 100, and it stays there for a long period of time. It doesn't really have any bearing on necessarily where things are going to go. And I think that's the case with a lot of these bonds that are now at very, very deep discounts. If we're roughly in the yield zone that we're going to be in, then they're going to very slowly take their time moving back to par. But I think, that shouldn't distract you from the real valuation question, which is the yield right or not?
Hey, Rob. Awesome to hear from you. Robert Tibb there of PGIM Fixed Income on this bond market. Bonds today firmer Looking pretty solid, actually. Yields lower by 8 basis points on a 10-year to 4.16 at the front end of the curve on twos, down 5 basis points to 4.45. We need to talk about the earnings. And for Q3, it was always going to be about the guidance. And what we've had this morning was a raise, a hold, and a cut. A raise from Coca-Cola, a hold, reaffirming the outlook from GM, and a cut from 3M, Tom, a little bit earlier this morning. Very mixed so far today.
Well, Gina Martin was talking about this yesterday. I thought she was stunning where she talked about 1 in 5 companies maybe have the glory of decent cash flow, decent margins, decent revenue. That's Coca-Cola. I would suggest maybe it's not even 1 in 5. It's even more narrow than that. And we'll see that narrowness today with Google and Microsoft this afternoon.
You know who I can see at the corner of my eye? Just sort of loitering out in the distance. Matt Miller is going to drop by the studio and catch up with the GM CEO.
It's probably out there in search of a Bitcoin floating around.
Is that what they do? They float around?
They float around.
Okay. That's good to know. Is that the depth, the knowledge?
That's the knowledge, yeah.
Of crypto here.
Matt Levine out with a great
I saw that.
full
Very
essay
cool.
thing. Bloomberg
Very
Business
cool.
Week, like a massive take on Bitcoin. I'll read it because I'm the dumbest guy in the room.
And because it's
Matt Levine.
Isn't it nice to see Matt on camera too? I think that's great. Did a little package.
Yeah, you know, his
for digital.
people finally agreed.
I've got
to
time
an
for that.
appearance, yeah.
How much should we pay him? Tons to finally get on camera. Good for him.
Crypto.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, you know, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer, like Marriott's Leni Oberg.
One of the most important things is looking around the corner.
Adrian Mitchell from Macy's.
We have to let go of the traditional legacy department store.
And Luca Zaramella at Mondelez.
We tend to believe that all consumers are equal. They are not.
Look for Chief Future Officer on Bloomberg. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
The day-to-day noise is exceptionally high right now, and it's really disturbing for a lot of investors.
This type of volatility is something that we think you'll see still for the next couple of quarters.
I think there's more work to do here before the Fed really believes that short rates are offering a positive real yield.
I think the thing people really need to focus on the most is how long does the Fed keep that funds rate really high?
I think the time has come for them to take a slower pace of rate hikes and wait and see what kind of shape the economy is in.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. This is Bloomberg Surveillance. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. We welcome all of you on Bloomberg Radio and Bloomberg Television. The common theme of the earnings season from industrial America this morning, John, right over to where we are with tech this afternoon, is dollar ramifications.
Alphabet and Microsoft coming up a little bit later, and FX is the brand new excuse available to CEOs worldwide, and 3M is taking that opportunity to blame FX, Tom. It's a real deal. The dollar is a whole lot stronger, and if you're an international company this year, Tom, it makes a difference if you're based here in the United States.
Multinational domestics, Liz Ann Saunders with a great chart from Schwab's showing that domestic company outperformance versus multinational and international as well. The conversation Jordan Rochester and George Saravelis that we had earlier is just simply not about yen. It's about a holistic thing, the developing economies, the EM economies, and there's real dynamics out there that these companies
the rest of the world wants this Fed to slow down, the step down.
No question
the
about
step
it.
down
The blink.
from 75
the blink down.
to 50. Is that what you're calling
They're
it?
going to blink down.
Nomura's not looking for that. They reckon 75 at the next meeting, and then another 75
but
basis
then what?
point hike.
Do we all agree, Lisa? Do we
after.
all agree 75? I get it. ECB and that. To me, it's the then what?
Well, and then at what point, if they do pause, right, let's say they do a step down and they get to 4.5%. Hold on a second. Then what happens then?
I didn't say anything.
But if they don't say anything, if they don't do anything further, is the further path going to be another rate hike, as we heard from Robert Tipp, because of the inflationary pressure?
Any call on the Fed is at the mercy of the CPI data, and we get another CPI print, Tom, in a couple of weeks' time.
And nation to nation, it's a huge variance as well. And as John Boivin said earlier, and John, to stagger to the data here, with inflation tied to the yield right now, 10-year yield 4.16%. The real yield comes back from that 182 down to 158. Everything linked together off that key inflation report.
Yeah, and not just in Europe and the United States as well. Setting the tone for this market worldwide this year and maybe beyond into 2023. Let's whip through the price action for you just briefly on the S&P 500. Slightly negative through much of this morning. No drama, though. We're down about 13 on the S&P. We're softer by 1/3%. Yields on a 10-year, lower. Negative, down 8 basis points on a 10-year to 4.16. And in the FX market, TK, softer euro here, just a little bit weaker, 98.63 on euro dollar.
If you were a student of the Midwest and you had parents that were industrial, on your college list was the West Point of Manufacturing and Engineering. It was called General Motors Institute, now Kettering. And never did they know that one of their students would come out to provide leadership for General Motors. She is Mari Barra, and Matt Miller brings us to her today, the engineer from the General Motors Institute.
I'm looking forward to it. Mary, thanks so much for joining us. Really appreciate it on such a busy day for you. Let me pick up where these guys left off and ask you about the stronger dollar. Obviously, the lion's share of your revenue comes here in the U.S., but you still purchase a lot of parts in your supply chain from outside of the country. Is the stronger dollar a tailwind for you?
Well, I think, there's a lot of pressures right now when you look at commodity costs, transportation. It's just one of the elements that we're facing is not as significant as it is for other companies just based on our strong position in North America. But we continue to monitor and be impacted by each of these factors.
Rates, obviously, a huge factor as well. We've seen it impacting other lenders, and I'm wondering how it's impacting GM Financial.
Well, we are seeing GM Financial get back to, I would say, historically strong performance. I think we had especially strong performance last year and the year prior due to the strength of used cars pricing that's coming down with interest rates. We are seeing a little softening on leasing, but overall, GMF is performing very well.
The CEOs of JP Morgan and Goldman Sachs both this morning have said they see a recession as likely for the U.S. I'm wondering your view. You have a unique position. what's the economy look like to you? How is it unfolding, and car sales specifically?
Well, I'm going to let calling a recession to the economists, not my expertise, but what I'll tell you what we are seeing, and we're seeing still very strong demand for our products. We're seeing strong average transaction pricing that we continue to be able to build on. And so, we are starting to see inventory build just a little bit, but well below levels that were in the past. So overall, we're still seeing a very strong consumer for our products. And, we're watching carefully all the different signs, but right now it's still very strong.
But what about inflation and the pressure on margins? I mean, does the stronger dollar balance that out? Are you seeing a big inflation in a rise in the costs that you need to pay out for parts? And is that sort of squeezing your margins here?
Well, we have seen, commodities, logistics, we work with our suppliers to make sure that we have a very healthy supplier base. So all of those factors, we tend to work to offset. And, we predicted this year it'd be about a $5 billion impact. And we are seeing that, but we have worked effectively to find offsets. And that's, part of our overall equation for this year, which is allowing us to still maintain guidance.
One big boost is going to be the Inflation Reduction Act. At least UBS says they see the IRA as very generous. They say it has the potential to make the U.S. a global EV battery hub. How do you see the Inflation Reduction Act for GM?
Well, General Motors was already investing in North America or in the United States. For instance, we have a battery plant in Ohio that's ramping right now. We have two others, one in Michigan, one in Tennessee, that are also ramping. So we were making the investments because we wanted to make sure we had a resilient supply chain after we've lived through so much disruption over the last few years. So as the IRA was passed, and we're looking now for Treasury to set the rules, we think we're very, very well positioned. And we do believe that the benefits of our IRA will drive stronger EV adoption with the American consumer. So we think it's going to do exactly what was intended to do, and we're well positioned to benefit and work with our consumers to make sure they have an EV that's affordable, that they can really enjoy the benefits of an EV.
Are you still on track to sell 1 million EVs in 2025 and beyond?
We absolutely are. When you look at the lineup that we have, starting with the Hummer to the Lyriq to now the Chevy Silverado EV, we just last week launched the GMC Sierra EV, along with the Chevrolet Blazer EV and the Equinox EV. I think we're going to be well positioned, covering the important segments in the portfolio to reach that 1 million unit level by 2025.
You do get a huge boost also from big truck margins, and I imagine that helps you to fund the EV business and get towards that target. If we have a recession and you see sales of those big trucks, those big ICE trucks drop, can you continue to fund the EV boost?
We very much believe we have a strong enough balance sheet and the strength of the business. When you look at the truck, we have truck leadership. We've had it since 2020, and we just did a major refresh to our light-duty full-size trucks. We have strong SUVs as well, and now the heavy duties we just revealed they'll be next year. So we think our product portfolio is going to position us well in the truck market. I would also say mid-size crossovers are very strong as well. And the truck consumer, especially the full-size truck consumer, they generally they don't shop as many segments as maybe other customers of other segments do. So we think we're well positioned, and obviously will moderate based on what happens from an economy and a consumer buying perspective.
Earlier this year, people were asking if we were going to get back to a 17 million SAR. Now I'm hearing people ask if we're going to go down to a 12 million SAR. What do you expect for car sales next year?
Well, we, because of all of the economic conditions around the globe, we are looking and we're planning for a more modest level. We're still going to protect for the upside because we don't know next year, but, we're at really depressed levels right now because of all the semiconductor shortages and other supply chain issues. So we think there's an opportunity to go up ever so slightly next year, but we're going to be very conservative as we plan for next year, but be ready to take advantage if there is upside. And there's still a lot of unknowns. We'll provide more information on how we view 2023 and early next year.
All right, Mary, thanks so much for joining us. Real pleasure talking to you on earnings day. General Motors Chief Executive Officer Mary Barra.
Matt Miller, just awesome, as always. Tell me this. I've been willing to ask this question for you for ages. How green is a £9,000 Hummer EV? Just how green is that?
Well, I suppose in what sense do you mean? There are zero tailpipe emissions. So
sure, so super green.
Right.
Now talk about how much goes into making a £9,000 Hummer EV. Then tell me about how much damage that does to the roads. Tell me about the tyre wear as well, how much rubber we'll need to put on these cars. Just how green are these vehicles when you have that, the life of the vehicle, the damage it does to the road, the new tyres that you're going to need.
Well, imagine if you charge it with electricity
that's
generated by coal. That's a problem as well. But I think that people like Mary and across the industry are looking for solutions to the climate crisis that we face. So yes, there are problems. You could see, or you could make the argument that it's not much more green than a Silverado. It's even bigger, it's even heavier, but at least they're making some headway in that direction.
Wouldn't I be better off buying a smaller gas auto?
That's un-American.
Seems dangerous. Would you want to drive around in a small car?
Wouldn't that be more green?
What if I hit you in my Silverado?
Matt, this is the ridiculous part of this conversation.
That's it.
Is this just a fad that doesn't really address what we need to address?
I think it's a piece of a much bigger
I get it, you can sell
solution.
a load of cars, I get that, clearly. And you can get the credits from the government to do so.
Americans love big cars.
But isn't that the elephant in the room here?
Yeah, but Americans
we're still
love
talking about
big
trucks.
cars.
We're
but
big
that's
people.
what they like.
Precisely.
Oh, come on.
I'm not here to say you shouldn't drive big trucks. I'm just here to say that this green branding of them seems to miss the mark a little bit.
I don't disagree.
I don't either.
TK?
It costs $110,000. There's like 12 people who can afford it.
I know. Anyway, Sam Stovall's coming up.
$110,000.
Chief Investment Strategist at CFRA from New York. This is Bloomberg.
And I love my Honda Civic for that. Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Rishi Sunak has formally taken over as the Prime Minister of the UK. Standing outside number 10 Downing Street, Sunak promised to fix the mistakes made by his predecessor, Liz Truss. He said the UK faces a profound economic crisis, and that will mean difficult decisions to come. NATO is increasingly concerned that Russia's desperation over battlefield failures in Ukraine may lead the Kremlin to escalate the war. That could involve a massive attack on a target like a dam or even a weapon of mass destruction. NATO says that for now, there's no sign Moscow is actually preparing for such an attack. Adidas has ended its partnership with Ye, the rapper and designer formerly known as Kanye West. In recent weeks, Ye has made controversial statements, including anti-Semitic posts on social media. Now that's turned his Yeezy line of sneakers into a lightning rod for criticism. Adidas says that ending the deal will mean a negative impact of close to $250 million in net income. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
What do Formula One cars and your local supermarket have in common? Well, strange as it sounds, they might both be using the same technology. A lot of innovation has trickled down from the world of high-tech engines, and it hasn't just found a new life in road cars. F1 cars have long been thought of as the peak of cool, and technology in them is also helping to cool down our produce aisles. Engineers from Williams are using their knowledge from 9 Constructors' Championships, working with company Aerofoil to help reduce the energy consumption of supermarkets. The device they're building is based on the design of an F1 car's rear wing. It attaches to fridges to keep more cool air in the unit. They estimate it can reduce supermarket energy consumption by 25%. One innovation from F1 is also helping hybrids reduce their carbon footprint. That's KERS, or the Kinetic Energy Recovery System. In common parlance, it's known as regenerative braking and works by storing energy of the car decelerating in a battery for later use. If that's not enough, F1 is now looking at TERS, or a thermal energy recovery system, looking to harness the heat produced from braking and the engine exhaust. That could allow cars to generate the same power using 30% less fuel. So while F1 may have a reputation as a gas guzzler, some of its innovations in the name of speed are helping in the everyday fight against climate change.
Hello, I'm Emma Barnett, and I'm a journalist and presenter. This is my new show, Emma Barnett Meets. First, I'll be meeting Chinese artist and dissident Ai Weiwei, and I'll talk to the novelist and political scientist Elif Shafak. Tune in to watch those who shape our world explain how the world shapes us. This is Emma Barnett Meets on Bloomberg Quicktake.
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
Earnings season is here.
The earnings are starting to pour in.
The numbers are holding up better than expected.
Sorry, business isn't all that bad.
Bloomberg breaks the numbers first.
Netflix earnings going across the wire.
A big beat. Stock is up more than 8%. Coming in stronger than their rivals.
With exclusive expert analysis.
Finally back to growth.
The mother of all opportunities.
What is the industry to watch?
That's where the rubber hits the road for Goldman Sachs.
It's going to be a really interesting earnings season.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
What people say they're doing with their money and what they're actually doing with their money, and I still think the gap between those two things is quite wide here. The flows, for example, are still pretty aggressive into both equities and bonds.
Chris Ferrone of Strategas, can I just say, with call of the year, you gave it to Priya Mitra of TD on the curve inversion. I think up there is that call from Chris on dollar yen. Looking for 150 when we were at 115, and we closed at 115 last Thursday.
Yeah, I'll go with
150.
That. Yeah, he was way out front on that. Yeah.
You give it to Mike Wilson.
Yeah.
Lisa, you're not alone, because Mike Wilson and Morgan Stanley,
#1,
whose long-held bearish view on U.S. stocks has materialized this year, was ranked the best portfolio strategist in the latest institutional investor survey. So congratulations to Mike and the team.
Cash?
You should.
The Decade Award.
Perma-cash, Tom. I'm not sure if that warrants an award.
Somebody from Governor Bailey's team said, how do you handle leverage there versus what we're going to see this week from BOJ, Bank of England, and, of course, ECB on Thursday. And please stay with us through the week on earnings, and we'll be talking about the afternoon earnings as well, such as Microsoft and Google today. Right now, we readjust on the equity markets with Sam Stovall, Chief Investment Strategist at CFRA. Always good to speak to him. Sam, Julian Emanuel keeps score on a daily basis at Evercore of what we see, and what he sees is a modeled 8.8% revenue growth. How do you, with all your experience, your STAR system at CFRA, what does 8.8 revenue growth, or whatever the number is going to be, how does that distill down through the income statement to free cash flow and then on to share price?
Well, good morning, Tom. Thank you for the easy question. Basically, what we're looking for this year, or at least in the third quarter, is a 10% gain in revenues for the S&P 500, and that compares with 2% earnings growth. Profit margins likely to slip a bit, about 7.5%. But when you look beneath, in a sense, the surface, the 10% growth really is driven by the energy sector, as well as the communication services, consumer discretionary categories. Tech is really expected to show only about a 5% gain in revenues.
We're seeing a theme of alpha, of individual stock selection. Is this a time, within the tumult now, is this a time, an era of individual stock selection, sector selection, or get out of the market selection?
Well, I think that one could say that we are getting to the point where we might be looking toward the market and sectors, because as you probably are well aware, the Stock Traders Almanac calls November through April the best 6 months of the year. And my seasonal rotation strategy will switch from the defensive staples and healthcare to the cyclical discretionary industrials, materials, and tech at the end of October. So historically, we are in the best period, the sweet spot for the market. October of midterm election years through October of the year after have posted an average total return of 21% since World War II and has risen 100% of the time.
Sam, what's the distinction for you between a bear market rally and the beginning of a more sustainable economic and market cycle?
Hey, Lisa. Well, I would tend to say that you've got to see some factors that really confirm the move higher to make it something that's more like the beginning of a new bull market rather than simply a bear market rally. One of the things we have not seen is a sharp capitulation, in a sense, the increase in volatility. I look at a rolling 15-day average between percentage of high and low for the S&P 500. Normally, we peak in a bear market environment above 2 standard deviations. Right now, we're pretty much hugging the average. So the volatility, the fear, the capitulation has really not been there yet. And I think we probably need to see that before we can say that this bear market is over.
So how do you view the whole step down that we've been talking about, or this idea that the Fed could decelerate its rate hikes, which is one reason some people have given as a narrative to the gains that we've seen over the past week? Do you buy into that if the Fed is compelled to slow the pace of rate hikes, that's a positive for stocks?
Well, I think if they're compelled, it could be for reasons that are more ominous. We have seen since World War II that whenever we've had a year-on-year change in CPI exceeding 6.5%, remember we hit 9.1% in June, we have had not only a bear market but also a recession, and that these bear markets fell further and lasted longer than bear markets without recession. So I would tend to say the real concern is when we do acknowledge that we are in recession, how deep will it be? And therefore, it was, an earlier low in October, the low or simply a low. And I would tend to say it's a low because I'm looking for something closer to about 3,200 on the S&P 500 that might end up toward the end of the first quarter of next year.
Hey, Sam, thank you. Sam Stovall of CFRA. Sounds like from Sam, Lisa, this could go on for another 6-9 months?
Yeah.
Something like that?
Yeah, at least at the rally could. And this sort of speaks to this idea that, okay, it's a bear market rally, but let's ride it, right? I mean, how many people are basically saying that?
That's what Mike Wilson's saying.
Because they're concerned that they get beaten up by being too bearish, at least in the near term.
Chris Harvey of Wales had it right the first time, and then he had to pull it forward. I tell you what, this game is tough.
It is.
And that's not criticism of Chris.
Yes. Absolutely.
Let me be very clear about that up front. Chris was talking about the weakness in earnings to come in the first half of 23. He brought that forward, and now it just feels like people are pushing it back out. People are pushing it back out. This cycle's just moved at such a speed that it's so hard to keep up with. And I think people are still guessing when the weakness will arrive.
Is it a cycle?
Well, Tom, when did it begin? Is it 2 years, or is it the 10 before as well?
I think to what Jean Boivin said, it is completely away from any demand structure. It's in the textbooks. It's all pandemic, supply-side dynamic, and that tells me it's not a cycle. It's original.
What I've heard is that because we've only had a couple of years of this post-pandemic, we haven't had the time to build up excess. And I guess, Tom, to your point, It depends on the starting point. Do you think this thing started after the pandemic, or do you include the 10 years before the pandemic as well?
Well, the people who say that there weren't excesses in the financial system are the same people saying that this could be a slow burn. That was Robert Tipp. That was Jean Beauvais, basically saying there will not be the trigger for financial stability at rates at 4.5%, and that they could stay there for longer, which will reset the concept of corporate valuations and corporate earnings.
I'll do this on Microsoft today, and what I'm doing is just going back and comparing where we are now to 2019 pre-pandemic, and that's the elite group of equities that have been able to improve on that.
You looked skeptical.
I just think what we've seen from central banks, we're already seeing the intervention. So this idea that it's going to be this slow bleed, the BOEs had to step back in and buy gilts. The BOJs had to intervene in the FX market. The ECBs had to come up with this transmission protection instrument that's not being tested yet. Talked about South Korea, smaller story obviously, but they've had to step back in and do something on the credit side. And I just wonder who's next, TK?
Jacob Rees-Mogg just quit.
Oh, it's big news, Tom.
It's big news.
Covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, today on Bloomberg.
Part of what I love about business is you get to build things from nothing.
I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full-service shadow banking with nobody in charge.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
60 minutes away from the opening bell, live from New York City. Good morning to you. The price action shaping up as follows as we approach that opening bell. Equity futures slightly negative on the S&P. We're down 0.4%. We are down 14 points. Ton of earnings this morning. As for the guidance, you've got a raise from Coca-Cola, a hold reaffirming from GM, and a cut from 3M. After the close a little bit later, you'll hear from Alphabet and Microsoft. Going into all of that, the bond market's supportive. Yields lower, down 8 basis points on a 10-year Tom to 4.16% in America.
Right now, let us look at possibly your book of the year. My book of the year, for the first time ever, I did it so early in the year on the shock of the war and Vladimir Putin and what we saw. Putin's World is my book of the year, but look at this, short, readable, mega threats, Nouriel Roubini, crisis economics coming out of the crisis, and now this shockingly readable. Nouriel Roubini joins us for the entire half hour. I'm going to go back. I want to give people a little vignette of years in my relationship. We're sitting at a wood-paneled Davos-like bar, and there's a very famous Secretary of Treasury sitting somewhat near us, and you and I walked through the excesses of 05, 06, and you nailed 2008. Are we there again?
Yes, we're here again, but in addition to the economic, monetary, and financial risks, and there are new ones, now we're going towards stagflation, like we've never seen since the 70s. In the book, I point out that there are also geopolitical risks, like we're on a confrontation with some revisionist powers like China, Russia, Iran, or Korea that are challenging the geopolitical order of the US and the West, and that's going to lead potentially to conflict. There are environmental risks that are very severe. There are health risks coming from pandemics, and there is a relation between global climate change and pandemics. There are technological risks coming from AI, machine learning, robotic automation, destruction of jobs. There's a backlash against globalization, and we're going to go to a world that is deglobalized. There are political risks. We have polarization, and we have radical extremist party of the extreme right and extreme left coming to power, both in advanced economies and in emerging markets. And on top of it, we have amount of the debt like we have never seen before, explicit debt and implicit as well.
That's right where I want to go.
So it's a confluence of all these mega threats, 10 of them together.
Lipsky at IMF was heated about the debt buildup. On the back of your book, you've got a guy named Rogoff from Harvard, Bremer of Eurasia, Dr. Alarian from Cambridge, Martin Wolf, always wonderful at the FT. And at the very top, the quote of the season from Taleb, the gravity's return to the physics. We've got a higher real yield now. We've got a risk-free rate now. What are the ramifications in our economic system that the gravity's return to our physics?
Well, there were many insolvent agents in the economy because private and public debt as a share of GDP has gone from 200% to 350 globally between 2000 and today. In advanced economies, more like 420 and rising. In the US, is now higher than after the Great Depression and after World War II, and we're not out of a Great Depression or a major war. And until now, even if you had zombie households, corporates, banks, shadow banks, governments, countries, they were built out. They were built out during the global financial crisis, zero policy rates, negative quantitative credit easing, and even during the COVID crisis, many of them were fragile. They were built out again. We went back to do even more of the same. This time around, instead, is different because we have so much debt, and central banks like the Fed have to increase interest rates to fight inflation, so the zombie institutions are going to go bankrupt. That's why not only we're going to have inflation and stagflation, but we'll have a stagflationary debt crisis. In the 70s, we had negative supply shock, 73, 79, but we had very low debt ratios. So we didn't have a debt crisis in advanced economies. We had one in Latin America. Argentina, Mexico, Brazil borrowed too much in the 70s. When Volcker jacked up interest rates to 20%, they went bankrupt. After the GFC, we had the debt problem, mortgage debt, housing debt, bank debt, and we had the debt crisis, but it was a negative aggregate demand shock, and therefore we had low inflation and deflation. Today, we have the worst of the 70s with a massive amount of stagflationary negative supply shock. In the book, I identify 11 new ones over the medium term. And at the same time, we have debt ratio like we have never seen before. So we get stagflationary debt crisis.
Well, don't give us the 11 themes, John, or we'll be here all day.
I was waiting for the 11th before I jumped in. You used this phrase in there.
I could tell you in the soundbite about 11.
But I'm not going to give you the time. You said zombie institutions.
Yeah.
Where are they? And are you talking about countries now? and not companies, not households, not private balance sheets. Are you talking about countries, sovereigns?
Well, there are plenty of sovereigns that are in trouble. In emerging markets, we know what has happened in Lebanon, what has happened in Zambia, what has happened in Sri Lanka, and there's about 40 of them that the IMF and the World Bank said that they're on the verge of having a debt crisis, severe debt crisis because of what's happening. And look what happened to the United Kingdom that now has started to be priced in like an emerging market with the fiscal stimulus reckless, forcing the Bank of England essentially to monetize it, and then the currency falling and rates going much higher until they reverse themselves. So it has happened in Greece, it's happening in the UK, it could happen in Italy. Of course, we have a large number of not only emerging markets that are at risk, but also of advanced economies that are at risk.
So over the last 10 years, we've had a series of counter-cyclical circuit breakers.
Yes.
Fiscal had the capacity to do that.
Yeah.
Central banks had the capacity to do that.
Yeah.
Seemingly, we're questioning the capacity of those institutions, central banks, sovereigns to be able to do so this time around. You offer solutions in this book too. What are they?
Well, for every one of these mega threats, there is a solution. But then there are two final chapters, one about a dystopian future where all these threats materialize, they feed on each other, and it's not just the end of the world economy, it could be even global war. And there is a less dystopian future in chapter 12 where we have the policies nationally and internationally that lead us to a better outcome. The problem is there are both domestic political constraints and geopolitical political constraints to achieving the best solution. And I'll give you an example of global climate change. Domestically in this country, half of the country doesn't believe into it. Two, there is a conflict between generations. The young people care about the future, the elderly care less. At the international level, there is a free rider problem. If a country cuts emission to zero, nobody else does it, then they don't get benefit and only the cost. And now because of geopolitics, we're telling India and China, you should cut your emission now to zero in the next 20 years, but we created a problem in the last 200 years. 90% of the stock of emission came from advanced economies, and now we're telling them, don't grow, don't become rich, because there is a problem. It's true, the flow of new emissions is coming mostly from China and India. So there are four elements of conflict, two domestic and two international, that they essentially imply that we're not going to find the right solution. So there's lots of greenwashing, green wishing, green fig leaves. A lot of ESG is just talk and no action. Glasgow COP was just a total failure, and or a slow motion train wreck.
Which goes to your point, John, about electric vehicles that are
£9,000 EVs.
£9,000 EVs in the United States because they are green. There is an issue, though, going forward with the central banks and whether a lot of your thesis, Nouriel, is predicated on their inability to go through with what they need to do to get inflation down. Is that your base case? Is that the most likely outcome?
Yeah. Right now, all central banks are playing tough and talking tough and acting tough, hawkish, because they have a problem of credibility. But in my view, there are two problems. One problem is that if they try to get to 2% inflation, they cause a recession. And this recession is not going to be short and shallow. It's not going to be garden variety. It's not going to be plain vanilla. It's not going to be 2 quarters of negative growth, then inflation collapses and they can ease again. In the book, I explain all the reasons why it's going to be a severe recession because of the debt ratio, because we're going into fiscal and monetary tightening. And at the same time, not only you have an economic crash, you're going to have also a fiscal crash. We're not only in fiscal dominance in this game of chicken between Treasury and central bank, we're in what the folks at the Bank of International Settlement call a debt trap. There is so much private and public debt that if central banks try to fight inflation, they cause a crash of financial markets, and not just the stock market. That's the least important. Credit market, bond markets, and that crash and financial crash feeds on the economic crash and vice versa, and therefore they're going to wimp out and they're going to blink. And the first one was the Bank of England. The Fed is going to do the same, the ECB is going to do the same.
Have you been surprised that we haven't seen some sort of catalyst, some sort of financial stress so far, given how quickly the Fed has already hiked rates?
Well, we have not yet seen it. Some people worry that some major financial institution, not in the US, may go bust. I think that the financial strains are going to become more severe because right now the Fed is on the way to go from 3 towards 5%. You already have a stock market down 25%, NASDAQ even more, public REITs 33%. You have the crash of Mimi, of SPAC bubble, of the crypto bubble, private equity, venture capital, growth, everything is down. Credit is down, leverage loan market is shutting down, CLO market is shutting down. And the only thing that used to be safe, there were government bonds. Now the price is correlated positively with equities. Because when inflation is rising, you lose money on your equity side, you lose money on your bond side. Yields have gone from 1 to 4, and the price action downward on bond has been worse than in equities, 30% losses. So any 60-40, 70-30 or risk parity portfolio lost money on both hands. There was nowhere to hide. Even cash gave you a negative real return because of inflation. There are other alternatives that can protect you against this tail risk, but they're not the traditional ones.
You're a man of high conviction. We know that. You've also got some very smart friends. Have you had any pushback to this book that's convinced you of absolutely anything, made you rethink how bad things might be, and possibly made you think that possibly they could turn out better than you think?
Honestly, everyone who has read it at any level has said that the threats you're talking about, they're all too real. Of course, there may be solution to them, and I discussed them chapter by chapter, and in the final chapter about the less dystopian future. But think of it this way: I have gray hair. I grew up in the 60s, 70s in Italy. At that time, did I ever hear about climate change? There was never a concept. Did I worry about the nuclear war after the detente between Soviet Union and US? There was nothing. Did I worry about AI destroying most jobs? We're in the AI winter. We had a stable democracy. We didn't have pandemics. Last time around was 1918. We had low debt ratios. We had low implicit debt because there was no aging of population and all that funded liabilities. There were no major financial or economic crises. This is a quantum shift. There was a period in 1945 and the mid-80s that was something of a stable period. Global prosperity, welfare, peace, and so on. Today, these are threats that did not exist. And those threats are more similar to the period between 1918 and 1945, when we had World War I, World War II, the Great Depression, trade war, financial crisis, inflation, hyperinflation, deflation, Nazis, fascists in Germany and Italy, Spain, and Japan, and we had World War II, and then we had the Holocaust, and then we had the Korean War.
Yeah.
As Neil Ferguson on Bloomberg is saying right now, in his column this week, he says, we'll be lucky if we repeat the 1970s, because it's more possible we end up like in the 1940s, meaning he's talking about World War III.
I love Neil, but can we be clear? That wasn't a column. That was a book on Bloomberg Opinion, wasn't it? Have you read that? You see that
it's a long column.
Yeah. Can you tell Neil that columns are short?
I love his column because, you know, he's speaking about the fact that there is a meaningful chance that we have conflict between, and I write it about in my own book. There's a chapter about the new Cold War between US and this revisionist power, and I say it could end up into a hot war. It's a significant risk.
Nouriel, fantastic as always. Nouriel Rabini's going to stick with us. I've got to go and get a drink after that and get ready for the next show.
Okay.
And not be too depressing. Have you got a favourite quote yet in that book?
No, you know, it's
the last two lines.
The last two lines.
Because it's carefully written.
You know why?
Carefully
You know why it's the last two lines?
Why is it the last two lines of the book?
Because our names are in it.
No, the last two lines of the acknowledgement is your name, but the last two lines of the book is about the threat.
There we go.
The mega threat that we are.
Nouriel Rabini, staying here on Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Shares of UBS are rising. The Swiss bank posted quarterly profit that beat estimates due to surging interest rates and cost control. That will enable UBS to confirm a plan to return about $5.5 billion to investors this year.
And also the liquidity in the market, because there is a limit to what we can do. Year to date, last Friday we were at 4.6. We will continue at the same level of speed. So we should be getting certainly over the 5 billion towards the 5.5.
Hammers is leading the effort to boost automation, slim down management ranks, and expand UBS's presence in the U.S. Global news 24 hours a day. I'm Lisa Mateo. This is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface, and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy, I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it.
You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Bloomberg's covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, today on Bloomberg.
Likely have a recession in the U.S. Going to have, I think, most likely a recession. We might be in a recession in Europe. And so until you get to that point that you see a change, whether it's in labor, the demand side, you're going to see central banks continue to move on that trajectory.
The economist from Goldman Sachs, our chief executive officer, David Solomon, there, pontificating on a recession as well. Of course, he's got the good advice of Jan Hatzius, which helps as well. Tom Keene and Lisa Bramitz, we celebrate and continue with Noya Rubini of Rubini Macro Associates, but far more, the new book, Must Read, Mega Threats. I really can't say enough about its terseness, its brevity. It really is timely, whether you agree with his caution. And as he says very clearly, the final chapter of the book is how we get to an optimistic future. I want to go to the past, and I was so pleased that you mentioned on page 37 your colleague, Alberto Alesina. I still can't believe we lost him at such a young age. You two looked at the politics of our economic system, Rubini and Alberto Alesina. I want to bring it forward to where we are now, which is a massive dollar shortage, and central banks, they've got a plan, but they're going to be overrun by a global dollar shortage in EM and, frankly, in developing economies as well. Is there a dollar shortage now, and is that the catalyst for central banks to blink?
It's going to be one of the catalysts. There is a dollar shortage, and the rise in interest rates in the United States is particularly dramatic for EM. They have a terms of trade shock, those that are importing commodities. they have a rise in interest rates because of what the Fed does, and they have their own domestic inflation, and that the weakening of the currency that increases the real value in local currency of their own debt. So for them, it is a perfect storm. Some of them have a lot of reserves, some of them don't have reserves, some of them have received IMF money, but there is right now a strengthening of the dollar that is implying even further tightening of financial conditions in the rest of the world. Now, I think that eventually the dollar is going to have to fall very sharply because we have a twin fiscal and current account deficits. In other advanced economies, you have a fiscal deficit, but you have a current account surplus. And now we're essentially using the dollar as a tool of national security and foreign policy. We're weaponizing it, rightly so. Sanctions against Russia, against Iran, North Korea, China. We're starting, by the way, a tech war with China, economic war.
What will be the catalyst for dollar weakness? How do we get there? Forget about this Plaza Accord. Gopinath laughed at me.
It's going to be essentially the Fed wimping out. Once you see a severe recession.
What does wimping out mean? That means blinking, right?
Yeah, blinking. They're going to blink and wimp out because you'll have a severe recession.
Wimp out, that's a new economic term.
It's
a mega threat to wimp out.
Well, either you're a hawk or you're a wimp, and so, or a dove in this case. But that's going to happen. And once the Fed is going to essentially prevent an economic and financial crisis, or try to prevent it by essentially stop raising rates, even inflation is too high, then the dollar is going to start sharply weaken. That's going to be the trigger for it. Because what's raising the dollar is, of course, the tight monetary policy.
A viewer wrote in and wants to know what you're doing with your money, considering that it seems pretty bleak out there.
Yeah.
You know, do you just stuff it into a mattress?
No, you don't stuff it in the mattress because then even cash loses money because of inflation. There are three solutions to the problems of inflation, the basement of fiat currency, political and geopolitical risk, and environmental risk. Solution number one is to have very, very short-term treasuries that adjust in rates and don't have the price action of long bonds that have fallen in their price. Secondly, you want to be into tips, even if tips right now have not yet done well because inflation expectations are not yet de-anchored. I think you want to go into gold and precious metal. Again, gold has not done very well because you had tight monetary policy, a strong dollar, but if central banks are going to blink and wimp out, gold is going to rise in value. Gold is going to rise in value also because the enemies of the U.S. are subject to sanctions. China now is worried. They have $1 trillion of reserves in dollar. They have to move to other things. If it's euro and yen, they can be seized. The only thing they cannot mentally resilient, because real estate compared to equities in a recession does well because you have more pricing power for rents and so on. So a combination of these assets provide you in an optimized way a hedge against some of these tail risks.
On the flip side, you've always been brilliant on leverage in the system, on credit. And we've heard from one fund manager after another that there is resilience in this corporate credit sector, even with the debt that they have, even with the low coupons that they're currently paying that will reset higher. Do you disagree? Do you think that people are overly sanguine about the upcoming credit cycle?
Yeah, right before the COVID crisis, the Fed was writing reports on financial stability, pointing out the leverage of the corporate sector. Of course, high yield and fallen angels. But then during COVID, these folks should have gone bust, but they were bailed out. We bought even high yield debt, you remember, commercial paper, and everybody under the sun. So the zombies were bailed out. And the excesses of having leveraged loans, CLOs, Cov Light got even worse, and people got even more indebted. This time around, the party's over because the Fed, for now, will have to raise rates. Those debt service ratios are going to become impossible, and you get the double whammy for those corporates. You get a P&L because income is going to fall because of the recession, and you get a debt problem with debt servicing ratio rising, and therefore there'll be a corporate debt crisis, one we avoided during the GFC and during the COVID crisis. It's coming now. The CLO and leverage loan market are shutting down right now.
I want to get to chapter 12 where you talk about a more optimistic future, a utopian future. You started by quoting the economist Yogi Berra. I thought that was very good. You go right in there about predictions and Yogi in the future and all that. How do you get from Yogi Berra to a more optimistic future?
Well, the more optimistic future starts with essentially technological innovations. Like, for example, I don't think it's going to be renewable. It might be fusion. If fusion happens, then you can have unlimited amount of essentially energy at cheap cost with no greenhouse gas emissions. We look like we are, however, only 15 to 20 years away from fusion becoming a reality. If it comes faster, then we can increase the economic pie. We're going to reduce the cost of energy. We're going to stop greenhouse gas emissions. We can grow more.
What about our fractured political? What about our fractured political system? Whether it's your Italy and the turn there to the right, or what we see in the election here coming up in 2 weeks. How do we get beyond this fractured political system?
For now, we're going towards a world that is even more divided domestically. There's more polarization, there's lack of partisanship, and it's happening. I mean, you have authoritarian regimes in power. You have Putin in Russia. You have Erdogan in Turkey. You have Kaczynski in Poland. You have Orban in Hungary. You have Meloni in Italy. You have these Nazi Swedish Democrats now in Sweden. You had the Brexit phenomenon, you had the Trump phenomenon, and in Latin America, it used to be only Venezuela, Argentina, populists of the left, but in the last 2 years, Chile, Ecuador, Peru, Colombia, and in Brazil, it's going to be either populists of the right or the left, either Bolsonaro, Lula. That's the world we're going. Unfortunately, it's a world that is not liberal democracy.
Have you sold the movie rights yet?
No, not yet.
Okay, DiCaprio, he'll love playing Robini. Nora Robini, where the book is Mega Threats.
Maybe a documentary series.
Yeah, exactly.
Rather than
10 dangerous trends that imperil our future and how to survive them. Did we survive the day?
Yeah, we did.
Earnings
Well, it's
this
still,
afternoon?
it's 8:55 a.m., so I think in New York City, we survived the day. We could say that. Coming up, we're going to be speaking about a lot more. That was very good. Perhaps Richard Haas, when he comes on later, will give us a sense of what his view is.
Mentioned by Nora Robini.
Exactly, and who read the book and gave it a huge endorsement. He'll be on Bloomberg Television later today. He is, of course, president of the Council on Foreign Relations.
Good morning.
If you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer, like Marriott's Leni Oberg.
One of the most important things is looking around the corner.
Adrian Mitchell from Macy's.
We have to let go of the traditional legacy department store.
And Luca Zaramella at Mondelez.
We tend to believe that all consumers are equal. They are not.
Look for Chief Future Officer on Bloomberg. The markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, equity futures just a little negative on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, we begin with the big issue. Same movie, different title.
We've had these head fakes.
The pivot trade.
There's moderation in the Fed talk.
These bear market rallies.
We've seen them before this year.
We've been here before.
We just did that back in June. Be careful not to declare premature victory on some of these rallies.
We don't want to get too comfortable.
A pivoting Fed is a bull case for equities.
It's hard to think that the pivot is anywhere on the horizon.
The Fed just started raising rates this March.
It's way too early to say capitulation. I mean, I think that's heroic.
The fundamental issue is that this is a market that has extraordinary impatience.
We're looking for messaging or any potential that they're going to pause.
Investors seemingly have no tolerance for pain.
As it's been the entire year, hope springs eternal.
Let's get to it. I'm pleased to say joining us this morning is Mohammed Al-Arian of Bloomberg Opinion and, of course, of Queen's College, Cambridge. Mohammed, always a privilege, a pleasure to catch up with you, sir. We've had the pivot, we've had the pause, and now we're talking about the step down. Is it just more wishful thinking, Mohammed?
First, good morning, John. Look, you're dealing with a market that for over a decade has been conditioned by central banks to look for liquidity catalyst. So that catalyst has gone from being a cut in interest rates to being a pause on rates, to being a slowing in rates. The only reason that would be justified as a catalyst is if you believe valuations are low enough, and if you believe we're not going to get derailed either by an economic or a financial accident. I think of it as a trading opportunity, but I don't think of it as the basis for a sustainable rally, not as yet.
You wrote about financial accidents, financial instability, earlier this week. You said inflation requires faster increases, which intensify the threat of large financial accidents that can have nasty economic spillovers. It is time to recognize that the speed with which interest rates are going higher for longer significantly increases the risk of financial stability. So, Mohammed, the ECB had to come up with TPI, the transmission protection instrument, whatever that is. The BOGs had to intervene in the FX market. The Bank of England's had to buy gilts, that gilt market operation of the last month or so. Who's next? How are you thinking about this?
So there will be next. What's common in all of these is that the source of disruption was the sovereign side, was something that these central banks could access directly. The issue for the US, the issue for Japan is the cross holdings, are things that the central bank cannot access directly with its balance sheet. And also, it is very difficult for the world's most important central bank to distinguish between monetary policy and financial stability, which other central banks can do more easily. So it gets complicated, John. This trilemma of lowering inflation, minimizing the hit to jobs and growth, and containing financial instability, it's a really tricky one.
One thing you've talked about, you wrote about it in the last couple of months, is pushing the brake and the accelerator simultaneously. I think it was an interview back on radio in the UK, Mohammed, where you mentioned that concept. Is that what you're expecting to see from the Fed? Because they're doing QT, they're raising interest rates. And one question I've asked Mohammed is how much longer they'll be able to do QT for, given what we're seeing materialize in the world in global markets.
John, the major problem is not QT. The major problem is this is one of the most front-loaded interest rate hiking cycles for a very long time. And we will get another 75 basis points next week. Will be 4 straight 75 basis points. And you're doing that within a system that has optimized low for very long and QE forever. So you have a system that optimized this. The Fed has no choice but to front load its hike because it's so behind and core inflation continues to go up. And it is how do you realign, if you like, the financial system to the new realities of these massive front-loaded hikes. It is not easy. That is one of the costs of being behind for the Fed. And the only concern here, John, is whether financial volatility undermines the real economy. That is what they should be looking at, and that is what they should be assessing, particularly when it comes to the non-banks.
Do you think it does?
I think it can. I'm hoping it won't, but I think it can. You know, it's a global economy that is slowing. We know that. That's not a great context to be doing front-loaded interest rate hikes. We have, and you've talked about it, many people who think a U.S. recession is a done deal. Bloomberg Economics says 100%. I'm not there, but a lot of people believe we're going there. And we have a market that I think has priced in interest rate risk, has priced in somewhat credit risk, and is hoping not to have to price in liquidity risk. So that is the configuration you have, and it's a very tricky one right now, John.
You just said I'm not there. Why are you not there yet?
Because I believe the U.S. labor market is still strong, and I believe that the Fed can hopefully still find a way around this. Am I comfortable? No. I've shared with you my feeling that the risk of a U.S. recession is uncomfortably high. I don't like it where it is. I don't think it's a done deal. I don't think it's 100%. The labor market is still strong, but it requires a Fed that has a lot more skill and a lot more luck, because it no longer has time.
You said the labour market was still strong. Do you think you can get inflation on a trajectory where they're confident, convinced it's heading back towards target over the medium term, Mohammed, without inflicting damage on this labour market?
A lot will depend on the wage determination issue. And you've asked a key question. And if you're wondering about what's going to happen to inflation, don't look at whether the price of gas is going up and down. Don't look at all the other things that we were looking at before. Look at how the labor market is functioning. Look at wage determination, because that's going to be the answer to whether we get even more stubborn inflation. The alternative being you only bring it down with a recession, which is not something that we want to see.
You've talked about the risk of a flip-flopping Fed, the 1970s. Remember that column from earlier this summer. Bill Dudley wrote a column for Bloomberg earlier this week, Mohammed, and he talked about whether this Fed was the Volcker Fed or the Fed of Burns. The latter not being much of a compliment, if you believe this is what Chairman Powell is right now. Any similarities to Burns or Volcker at this point, Mohammed? You've read that piece. How did you react to it?
It's a good piece. You know, Bill produces really good, thoughtful pieces that should be read. Look, it's clear what Chair Powell wants. He wants to be associated with Volcker. He wants the credibility, to borrow the credibility of Volcker, and he has cited Volcker in virtually every public statement since Jackson Hole. So it's very clear how he wants to be seen, and for good reason. If you can borrow that credibility, you don't need to be as aggressive on rates. The problem that he has that Volcker did not have is a trilemma. Volcker dealt with growth and inflation. Chair Powell has on top of that financial stability. If they pivot, it will be because of financial stability. It's not going to be because they've decided to not look at inflation anymore. It will be because of financial stability. And the risk here is that we get a quagmire of stagflation as we try and lower the financial stability risk. Again, John, that is what happens when you're late. You have fewer degrees of freedom.
Two pieces there. Let's pick out the first one, and then I'll get to the stagflation story. Do you think there's a difference between what Chairman Powell wants to signal and what he actually wants to do?
I hope not, because credibility is critical in this process. So I hope not. I hope that he's signaling what he wants to do and that he will remain on that path. Otherwise, forward policy guidance gets really undermined.
I remember there was something you said, and this picks up on the point you made up at the end there on stagflation. You said earlier this year that we might have to get to a point where we just tolerate higher inflation. We basically have a choice. It's either recession or tolerate higher inflation. Are you leaning in one direction more than the other at the moment, Mohammed?
You know, this is like the old lives versus livelihoods discussion when we had COVID in the beginning. And the answer to that is not to pose the question that way, but to have both lives and livelihoods. Look, that discussion, if you remember, had more to do with longer term. Will central banks and will society accept a higher inflation target to allow all these structural changes to take place within the economy? And the reality is that if you were designing the inflation target today, you would not come up with 2%. You'd come up with something higher. The reality also is that changing what you have now is really difficult, especially when inflation is a problem. So we're not going to see a change in inflation target. We will probably end up tolerating exposed to higher inflation than we would have otherwise. The key issue, John, I keep on stressing this, and I was really happy at the annual meetings of the IMF and the World Bank to see this has become a topic. Financial stability. Just don't underestimate that how you can break something in the financial system, and you've got to keep an eye on the non-banks.
Mohammed, if financial stability or financial instability causes a pause of this Federal Reserve hiking cycle, is that bullish or not?
Some may see it as bullish. I wouldn't say it's bullish because if this happens, it's because we got very close or had a financial accident. And if that happens, then you have another shock to growth. You have another shock to corporate earnings. And then you would need liquidity somehow to overcome so many walls of worry that I'm not sure liquidity can do it anymore. You know, liquidity helped us a lot when we didn't have inflation, when growth was okay. It wasn't great, but it was okay. When corporations were achieving efficiency gains. We're not in that world, John. We're in a very different world. You know, don't forget there's also supply chains that are being changed. This is a very different world.
Mohammed, this would have sounded very depressing, except I spoke to Nouriel Roubini about 15 minutes ago, and that set the bar really, really low for this conversation, and I'm walking away from this relatively happy. Mohammed, you're wonderful. Thanks for being with us, as always. Mohammed Al-Arian of Queen's College, Cambridge, on the latest in this economy and this market too. And for the Federal Reserve, futures right now, down about 1/10% on the S&P. Tons of earnings through this morning. On top of that story is Kaylee Lyons. Hey, Kaylee.
Yeah, it's a big day and a big week, John. About $5.3 trillion worth of market cap is reporting. And altogether with the reports of this morning, we have now seen about a quarter of the S&P 500 reporting. And so far, not so bad. Actually, when you add in this morning's reports, we are to profit growth on average on a year-on-year basis of about 0.9%. 58% of companies topping their results from a year ago. You're also seeing growth on sales of about 10% and upside surprises on both metrics. About 71% of companies reported thus far have topped expectations when it comes to profits. As for some of the companies that have done so this morning, GM is one, handily surpassing estimates with a record revenue and affirmed full-year forecast. So it's up about 3.3%. You have Coca-Cola and UPS up about 2.5% each after beats of their own. Coca-Cola is really about revenue growth driven by higher prices. One outlier on the negative side, though, is 3M, which again cut its forecast for the second time this year due to a strong dollar and economic uncertainty. So it's down about 3.5%. And of course, that's not all. We have more reports coming after the bell today, including giants like Alphabet and Microsoft. And those companies, along with their peers, are expecting to see a material slowdown from the sky-high revenue growth we saw just a year ago. Meta, for example, expected to actually see sales declines of about 6%. For Apple, Alphabet, and Microsoft, we're expecting single-digit revenue growth. Just to put that in context, that would be the first time we haven't seen double digits on that figure for Microsoft in 21 quarters. And that's just on the top line. On the bottom line, profits for Apple, Microsoft, Alphabet, and Amazon and Meta are expected to fall by the most in at least 3 years. And remember, those names together make up about 16% of the S&P 500, John.
Kaylee, unreal. Thank you, as always. Kaylee Lyons there. The team after the close, at the close, will break down those numbers for you from Alphabet and Microsoft. Coming up, geopolitical concerns, raising the stakes for Democrats ahead of the midterms.
I have not seen this letter. I will say this, that we're certainly very thankful of the bipartisan support that we have seen over the past several months during this war from Congress, and we're going to continue to keep those lines of communications open.
We'll talk about that letter next.
of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg. Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
The geopolitics was going on in Russia, Ukraine, America, China, the relationships of the Western world, and that would have to be far more concerned than whether there's a mild or slightly severe recession.
Geopolitics front and center for Jamie Dimon as a group of Democrats urges President Biden to shift his strategy on Ukraine, writing in a letter, quote, "We urge you to pair the military and economic support the United States has provided to Ukraine with a proactive diplomatic push, redoubling efforts to seek a realistic framework for a ceasefire, including direct engagement with Russia." Progressives quickly walking back the letter, but not before raising questions of cracks within the party. Bloomberg's Anne-Marie joined us now from the White House for more. AMH, walk us through this one, please.
So this letter comes out, Jonathan, and the White House swiftly says that there will be no talks with Russia if Ukraine is not represented. And also you had Admiral John Kirby, the National Security Council spokesperson, saying Mr. Putin is clearly in no mood to negotiate. So then you have these progressives walking back some of these comments and wanting to clarify that this is not them putting pressure on the Biden administration to change tact, but just wanting to offer a diplomatic solution alongside what is happening, which is a ton of money being sent to Ukraine and the fact that they don't want this protracted war. But clearly, Jonathan, what you are seeing is that there could potentially be some cracks within the Democratic Party. You and I just yesterday spoke about what Kevin McCarthy, the House Republican leader, talking about that there's not going to be a blank check anymore for Ukraine potentially in the new Congress. So I think what's clear is that the strategy for Ukraine during 2022 may change for 2023 after the midterms, and you see a ton of pressure on these lawmakers on the economics of what's going on in the United States. We should note that for the Kremlin, this is something they will have laser eyes on, not just cracks within the United States, but really the NATO alliance writ large.
Ahead of a key vote, AMH, thank you, down in Washington, 2 weeks away from the midterms. What do the midterms mean to this market, if anything at all? This from Wei Li and the team over at BlackRock. Equities usually do well after US midterms. Why? Gridlock is common and prevents policy change that could spook stocks. They went on to say, we don't see that past playbook working this time due to the recession we expect from the Fed ratcheting up rates. Joining us now is Julie Beale of Kane Anderson Rudnick, Richard Bernstein of RB Advisors. Julie, first to you. Does that line from BlackRock resonate with you?
Yeah, I think that understanding the underlying risks that we have is more important than, the previous historical data. For sure, we can understand why gridlock is positive from a regulatory standpoint, but I think at the end of the day, the fundamentals of, slowing consumer and higher interest rates is going to be more important than anything else.
Richard, let's talk about the fundamentals. I have a lot of people who tell me now that we've priced in the bulk of this rate hiking cycle with a peak in the Fed funds of about 5%. I have a lot of people also telling me we haven't really fully discounted the consequences of that hiking cycle. Richard, how would you respond to that?
Jonathan, I would say not only is there the questions about whether the hiking cycle is over, which I think is a bit premature to start talking about pivots and things like that with inflation, headline inflation at 8.2%, I think is very premature. But the other side of that is that there's been very little discussion about earnings and how we are really heading towards a profits recession in the first half of 2023. We haven't yet seen analysts just completely capitulate on their earnings forecast. You still have this notion that a lot of stocks are going to be immune to the economy, even though the stock prices are down. You haven't seen the capitulation yet on that.
It's something Mike Wilson has said over at Morgan Stanley as well. Judy, are you seeing any signs of that earnings weakness start to emerge? Because what I hear from the equity bears is that that's a story now for 2023. You're going to push that story out to early next year.
Well, I mean, so far, earnings have actually been pretty robust. I've been impressed by the level of strength and underlying, opportunities for companies. Guidance hasn't been great. And I think it's important to factor in that, we talk about currency as being, well, I'm going to look at these numbers, the, X currency, right? Because I want to understand the underlying growth rate. But at the end of the day, free cash flow is still in US dollars. And so inflation has an impact as well as currency. So I think it's important to bear in mind that FX is not just this overlay that we put on things. It actually has a meaningful impact on what the profitability and finances are going to be for these companies. And I think that has definitely not been priced in.
Judy, you've talked about the weakness of the consumer. We've just had house price data, home price growth in the US slowing the most on record. We've got a bid back into the bond market. Yields are lower by 11 basis points on a 10-year, on a 2-year by about 5 basis points. Judy, as I say, and I'll repeat myself, you've warned repeatedly about the weakness that you think is going to emerge in this consumer. Are you seeing that right now off the back of what is happening with things like home price growth?
Yeah, if you think about the U.S. consumer, so much of their wealth is actually tied up into their homes. And so for the moment, you're seeing quite a bit of stickiness in terms of people being willing to price down their homes because they're not really being forced into doing that. Many people refinanced during the last 3 or 4 years. And so they don't really want to step out of their house, if they're paying 3 or 4% interest to step into 6, 7, 8% interest. So I think that creates a lot of stickiness in the housing prices. But once they have to start coming in, once you start getting those comps of people who have to sell, people start to feel a lot less wealthy, and I think that starts to impact demand and behavior.
Judy, you do something that I do that I'm not sure many people in our audience do, which is you go on Rightmove in the UK and look at house prices. I do that every single day, and I'm happy to share that with you. Judy, what do you learn when you go on Rightmove in the UK to look at house prices?
Well, the UK market is really different, and I think people underestimate that. Is half of homes in the UK are owned outright, and so I think that lends a little bit more stability to their market. But you also have 2/3 of homes that are forced, so that could be overwhelming debt, divorce, or death. Those are the 3 Ds. And so that creates a certain underlying stability in terms of the transactions that are going to get processed. So I think Rightmove's actually really well positioned in that business. But yes, I love spending time on Rightmove. It's a delight.
Likewise, it's an addiction, maybe an unhealthy one. Richard, final question to you, sir. Looking at this bond market and the way it's responding to bad news, do you think this bond market starts to respond to bad news in the way that we would expect it to? Can you buy bonds going into this downturn?
So, Jonathan, I think, if the Fed does continue to raise rates, the natural reaction, what history suggests, is that the curve will invert not only by the Fed raising short-term rates, but by the long end of the curve starting to rally. In other words, sensing future slowdown, sensing a future recession. And so I think if, one has a 6 to 12-month time frame, then certainly the long end of the curve is starting to get attractive. If you're worried about the next 6 to 12 weeks, maybe not. Because I think, as the Fed raises rates, if inflation stays higher for longer than people think, clearly, especially in the likelihood of QT, the 10-year is not going to perform very well in the next 6 to 12 weeks.
Richard Bernstein, Julie Bill, to the two of you, thank you. That housing data, not pretty. We're down 11 basis points on a 10-year to 413 on a 2-year. To about 446, lower by 4 basis points. Up next, the morning calls, and later, 4,300 on the S&P in the next 6 months. That's the call from Stifel's Barry Bannister.
there still room for Abenomics to be carried out in full in the way that Shinzo Abe imagined it?
The economic situation that Prime Minister Kishida faces today is very different from the one that Abe Shinzo was faced with when he became Prime Minister 10 years ago.
Does Japan need a new policy? Is that what Kishida has to learn, or are there parts of this that he should hold on to?
I think there are probably parts that he should hold on to. I think the main challenge which Japan faces is demography. The population is declining, rapidly aging. Women are totally underused in the labor force, especially educated women. One needs to think about increasing immigration. These are issues that Abe tried to address, but a lot more needs to be done to quote-unquote revitalize Japan.
Minutes away from the opening bout, just about turning positive on the S&P 500. The house price data out of the United States, not pretty at all. Bond yields roll over just a little bit more on a 10-year. Yields lower by a little more than 10 basis points. Your 10-year right now at 4.12%. That's the price action. Here's some morning calls. First up, Piper Sandler upgrading Planet Fitness to overweight, expecting a jump in memberships following recent channel checks. Your second call from Wow's upgrading Ross stores to overweight, highlighting the retailers improving fundamentals and shrinking inventories. And finally, KeyBank cutting price targets on Alphabet and Meta ahead of earnings, growing skeptical of future revenue growth amid mounting recession fears. That stock positive by 0.6%. Your earnings wrap up next.
Consumers are very aspirational. You've got millions of people riding motorbikes, and they want to be riding inside cars. Vingroup, Vietnam's biggest conglomerate, has really tapped into that. The founder and chairman aspires to be the Elon Musk of Vietnam.
Vuong is Vietnam's richest man with outsized ambitions. He wants to sell cars not only to the Vietnamese, but also Americans and other consumers around the world.
If VinFast is successful, that goes very well with the ambition of the Communist Party of Vietnam. But if they fail, it will be very, very hard blow to Vingroup and also to the national economy.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer, like Marriott's Leni Oberg.
One of the most important things is looking around the corner.
Adrian Mitchell from Macy's.
We have to let go of the traditional legacy department store.
And Luca Zaramella at Mondelez.
We tend to believe that all consumers are equal. They are not.
Look for Chief Future Officer on Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
4 seconds away from the opening bell this Tuesday morning. Good morning to you. Over the previous 2 days on the S&P 500, up around about 3.6%. Friday and Monday, really strong days of gains on the S&P. Futures just about unchanged, just about turning positive off the back of some really dreadful house price data in America. Switch on the board and have a look at the bond market off the back of that. Another leg lower on 10-year yields, down by 14 basis points now on a 10-year, 4.0979%. Off the back of that move on yields, I can tell you some dollar weakness kicks in and some euro strength. Euro dollar reclaiming a 99 handle, 99.27, up a half of 1% on that currency pair, and crude reclaims 85 on WTI, $85 a barrel, up around about a half of 1%. In the equity market then, around the opening bell, what are we, about 20 seconds into this on the S&P? We're positive by just a tenth of 1%. A little bit later, though, all about the earnings. Big tech headlining a monster week. Microsoft, Alphabet, Amazon, Apple, Meta, all on deck. Dan Ives of Wedbush calling it the moment of truth for the tech sector. I think Dan said that about 10 different times over the last couple of years. But anyway, we're entering a crucial 3Q earnings season that'll either expose negative underlying fundamentals across tech, cause massive earnings cuts into 23 and further multiple compression, or prove that the bearishness and demise of growth tech was premature. Ed Ludlow has more. Hey, Ed.
Yeah, good morning, John. It's really a make or break week, especially for the 5 biggest tech stocks by revenue. If you take that quintet, which starts with Alphabet and Microsoft this Tuesday, but also includes Apple, Amazon, and Meta, EPS is forecast to decline 22% year on year, the biggest drop in EPS since 3 years. And this mega cap group of 5 faces its 3rd consecutive quarter of shrinking profits. Even so, look at the green on the screen. Traders have kind of turned defensive in recent sessions, driving up these stocks. I think on the NASDAQ 100, we're up for a 3rd consecutive day, the best streak of gains since for about a month's period of time. But each company has its own story, right? The overview is shrinking profits across all 5, 22% drop on EPS year on year for that 5. Thinking about Google, we still expect top-line growth for the Alphabet of 12%, more than the average of the S&P 500. But after the ad shock from Snap, we are asking questions about the resiliency of search and the questions about YouTube, and any sort of wavering in commentary could change projections, which are for the story around Alphabet to improve over the next year. Microsoft, really interesting, if you're coming into my Bloomberg terminal, projected to have its first single-digit sales growth, non-double-digit sales growth, going back 21 quarters. I think that gives a real sense of how the picture's changed. In terms of your earnings calendar, John, this is what the week looks like. We start with Alphabet and Microsoft this Tuesday, but it's a brutal week, and it all comes to a crescendo on Thursday, where you have Amazon and Apple, the kind of key names, but look at the others sprinkled throughout. Intel also going to be massively important, given the commentary, I suppose, we're seeing out of the chip sector.
Just about come to terms with calling Google Alphabet. I still can't call Facebook Meta.
I know, I apologize.
Meta, I'm just not there yet, Ed. One of the best, Ed. Looking forward to your coverage, buddy, a little bit later after the close. Ed Ludlow there on the West Coast. Sticking with tech, MKM's Rohit Kulkarni. Lowering estimates on Amazon, Google, and Meta ahead of results, cutting price targets despite keeping a more optimistic outlook in the longer run. Rohit Kulkarni joins us right now. Rohit, fantastic to catch up with you, sir. It's been too long. Let's just start with the cut to Amazon, if we can. It seems to me in your note that this was focused more on the e-commerce side of the business. Walk us through what you're seeing.
Hey, thanks for having me. And again, defensive is the name of the week this week. On Amazon, I think it's just about uncertainty and limited visibility. The way we are talking to a lot of e-commerce sellers, Prime Day that happened in October, whether that pulled forward some of the demand away from November into October. So I think for e-commerce, the concern here is do we have visibility into what the consumer is going to do during November and parts of December? I doubt Amazon would be saying that consumer is healthy and we see a lot of good traction in e-commerce. So I think that's where we are cutting numbers. I think Amazon would err on the side of being more conservative when they give guidance. I think they have already had one too many misses in the last 3-4 quarters. So I think they would be conservative. They would say, we don't know what's going to happen in November or December, so we are going to have a wider range of guidance. So might as well be prudent about that. Street would interpret that as, this is not great good news, so probably let's take the foot off the pedal. So that's where we think near term there is no visibility into what's going to happen, and that's why a lot of stocks are going to stay range bound in the near term.
Rohit, we've had what I would call a capacity demand mismatch over the last couple of years. They had tons of demand race to build out capacity, they build out capacity, and then the demand starts to weaken. Rohit, have we worked that out yet, or is that something that's going to take a whole lot longer from here?
We are probably in the, using a sports metaphor here, we are probably in the fourth or fifth inning of, we are midway or probably ahead of the midway point. So this Q4, we are going to see that capacity getting utilized. But again, come 1Q, they've already built those fulfillment centers. They're going to be empty in 1Q. So there is a point of time until probably mid of next year, which is when Amazon would have grown into the demand that they would have otherwise needed to have that capacity utilization to the optimal level. So there is still probably under 3 months, maybe 6 months before we actually see Amazon start to inflect on profitability on the e-commerce side. But yes, they also have the largest cloud company there, which also churns out a lot of cash. So there is going to be a whole lot of focus on how much are they going to maintain the profitability on the cloud platform right now.
We're also looking right ahead at what's happening with ad spend at various companies, looking ahead to Meta, to Alphabet on that front as well. On Snap, you said Snap had difficulty remaining under control of its own destiny. Your quote, do you think the likes of Meta has control of its own destiny?
They're not as out of control as Snap. Again, Snap is a very small and tiny company. What they say is probably a small part of the entire mosaic of ad spend. Yes, ad spend is slowing down. Ad spend is definitely going to be slower in 4Q, but it's not falling off the cliff. It is at a point where it is getting turned on and turned off in a way that can hurt smaller companies a lot quickly than larger companies that tend to be almost like the tax on internet. So Google is the tax on internet. Facebook to some extent is a tax on internet. So the first dollar spent always goes to these two companies, and the waterfall tends to kind of dry out as you go to smaller companies like Snap and others down the waterfall. The only thing that I would say is if Snap was weak, brand spend is weak, so probably YouTube is going to be weak. Maybe Twitter is going to be weak. So that's how we tie the loose ends here, not so much for search or not so much for Facebook as such.
Hey, can we finish on Twitter? I imagine not a company you'll be following for much longer from here, given the fact it's likely to go private in the not too distant future. Twitter reports, the reports around Twitter that they're cutting 75% of the staff if Elon Musk comes on board when that gets finalized and that deal closes. Rohit, as you look at the company, have the best already left? Are they waiting to watch what happens here?
Again, I would characterize 75% cut for any company to be highly egregious in nature. I think there is partially some of it is signaling, some of it is Musk trying to save severance dollars by kind of accelerating the voluntary churn, if you will, is my interpretation. But when it comes to retaining talent and it's very costly here in Silicon Valley. So I think that's going to be challenging for Twitter. There are still a lot of private companies that are doing a lot of innovative work, and Twitter, under the next, probably call it 6 to 12 months under Musk umbrella, is going to have a lot of volatility. So yeah, that is going to add to probably some market share loss from Twitter to smaller companies like Snap and Pinterest.
Rohit, wonderful to catch up with you, sir. Don't be a stranger. Rohit Kulkarni there on the latest. Snap, Meta, Twitter in early trading positive. Equities right now, just about positive on the S&P 500 by 0.2%. The Nasdaq up 0.6%. Yields are a whole lot lower. Two's out to 30s. On a 10-year, we're down 14 basis points. On a 2-year, we're down 8. Keep going back to this house price data out of the UK. Home price data out of the United States, rather. Really not good at all. Stifel's Barry Bannister is looking for this S&P to rise 13% in the next 6 months. Peak Fed hawkishness is in the price. Expect inflation to cool, delaying recession into mid-23 and lifting the S&P 500 to 4,300 in the next 6 months. Barry joins us right now. Barry was excited for this, the road to 4,300, so let's get to it. You say we've discounted the rate hiking cycle. Let's talk about the economic weakness. How do you manage that? You just push it out to 23 and ignore it until when?
No, the economy is slowing, and you want that. You want inflation to slow as well, and so does the Fed. The question is, as Sam Zell once said, every day you don't sell, you buy. And every day that the Fed doesn't turn the volume dial of tightening to the right, they're actually easing. And I don't expect incremental tightening, certainly not beyond what's already in Fed funds futures. It's not necessary. If I can break down with Thomas Carroll the inflation into energy, food, goods, durable and non-durable, as well as shelter and non-energy, non-utility services, and then find leading indicators, all of which point down for inflation, then the Fed can do the same. And they know inflation's going to come down. So the slowing economy, former Chair Yellen's comments at Treasury the other day about bond market concerns at the Treasury, all of this gives cover to the Fed, I think, to move towards not tightening further, and in fact, in the first half of 23, possibly taking one or two of those rate hikes close to 5% out of futures. It isn't necessary. We're going to get lower inflation and lower growth, but it's not a classical recession.
So Barry, talk to me about how you ultimately play this through the equity market. Let's take a data point this morning. House price growth comes in weaker, softer, negative, worse than expected. Bonds rally, yields lower by 14 basis points. In that kind of world, what do I want to own in the equity market? The cyclicals or the big tech names? Which one is it?
Well, as you know, the stock market's just a trade-off between two questions: economic growth, which drives earnings, and inflation, which drives your multiple. So price earnings times your earnings. That's your price. If you look at where we see inflation going, it's lower, so disinflation from a very high inflation environment. And if you look at economic growth, we do think it's weak, but again, a recession is income, production, employment, investment, and sales. I don't see that kind of universal weakness that you would classify as an NBER recession. So if I think the economy is slightly better and inflation is weaker, it pushes you back into growth stocks, and that would be big tech. So we'll see how the earnings are this week. You also want some cyclicals, though. I think the economy is oversold, and typically October to the following April, they're pretty good trades. It's a bad thing to fight that, just like it's a bad thing to fight the Fed. And so I like early cycle cyclicals. These would be banks, even housing for the intrepid, and semiconductor short cycle cyclicals. So I would go with cyclical, and I would go with a combination of growth and value.
Barry, when you say the economy's oversold, let's build that out just a little bit more. I'm looking at high yield spreads at about 500 basis points. Historically, sort of slap bang on the average kind of spread you'd expect, and certainly not the kind of spread you'd expect in a recession. Can you learn anything from credit here whatsoever, Barry?
Well, I look at high yield and IG, and the spreads are up, but they're certainly not worse than they were in the last decade. You think about 2011, 12, 2015, 16, 2018. We had some pretty big spikes there in yields and spreads. But if I look at the leading indicators for that, I don't see the kind of weakness in the default rate implied in those spreads that would justify a hair on fire panic moment here. I think the market is going to see a slowdown, it's already discounted a slowdown, and the question is it going to get substantially worse and cascade into a recession? I don't think that's going to happen before middle to third quarter of 23, and that depends on what the Fed does really in the next 6 months.
So Barry, of course, it comes to the price of the story, and I think the Fed game and the game around economic weakness feel like two different games. Barry, when you say to me we've priced in the bulk of the hiking cycle with a peak of Fed funds at 5%, I think most people would agree with you. When it comes to the consequences of that, the economic weakness associated with it, if you look at asset classes right now and ask yourself, how far are we on the road towards adjusting to a weaker world of economic growth? Some people push back against that, Barry, and point to credit spreads and just say, we haven't done the hard work yet. What do you say back to them?
Well, back to the spreads. I mean, the corporates have termed out a lot of their debt. We don't have the crash in energy and raw materials that drove, for example, that huge spike about 6 years ago in high yield. So I am pretty optimistic that we won't have that kind of a blowout of spreads. They also are fairly cash rich, although the cash is not evenly distributed among the corporates. One thing I would say, though, is that when I look at the Fed funds futures, for example, Bloomberg FFJ3, the May futures, it's 5%, okay? It's just under 5%. That's about 0.5% more than the Fed probably needs to do, and we'll get some clarity on whether that's going to happen in the first quarter of 2023. If they start to backpedal a little bit, and I thought, again, Yellen's comments the other day were very important political cover, really, for the Fed. She rarely says anything that's not thought out in advance. Very smart lady. For example, she endorsed a second term for Jay Powell publicly in late 21 when it was being waffled on by the White House. So When she made that comment about bonds, I thought that was very important for the Fed because they can use that as part of their holistic cover to throttle back if the economy slows and inflation slows, as I expect.
Hey, Barry, we've got to leave it there. Can I just say, don't wait too long to come back on. It's been too long. Barry Bannister there at Stifel. Barry, thank you. Need to look at Chinese tech as well. The Nasdaq Golden Dragon China Index, 65 Chinese stocks in that index, got absolutely battered yesterday. Baba, JD, Baidu all tanked at one point yesterday, close to 20%. Baba today, Alibaba, up by about 1%. I can tell you where the weakness continues. It's in China's currency. Coming up, that currency extending its declines to a third day.
From a trade perspective, you could argue that dollar CNY could potentially go north of 750 quite quickly. Quite quickly, I think, is what the Chinese want to stop.
That conversation up next.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
My grandfather got into the mutual fund business because the average investor could not get a diversified stock portfolio, and it was too dangerous to put, your entire savings in just a couple of companies. So the mutual fund was created to give a diversified expert management at a reasonable price. Today, we have a phenomenon where companies are waiting much longer to go public. And so in 2000, the average company went public after 3 years. Now, companies are waiting 9 to 10 years because there's so much money available in the private markets. As a matter of fact, there are half the number of public companies that there were in 2000, and there's 5 times the number of private equity-backed companies. So just from an investable universe, you look at the private markets, and it's significantly bigger. So the question is, that return that used to be captured in the public markets is now captured in the private markets. But the problem, as you know, is you're really tied up for a long time when you invest in a private equity fund. And so trying to figure out a way to solve the same problem my grandfather was trying to solve, which is how do you bring those returns responsibly, the democratization of the private markets to the retail investors. And I describe it as a bit of like running with scissors. Scissors is a great tool if you use it appropriately. And so we're focused on trying to figure out responsibly bringing it in to the average investor.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
From a trade perspective, you could argue that dollar CNY could potentially go north of 750 quite quickly. Quite quickly, I think, is what the Chinese want to stop. When you look at capital flows, yes, we've had capital outflows in terms of bond markets and equities, but it has been relatively orderly.
China's yuan plunging to multi-year lows, signaling the PBOC is loosening its grip on the currency and stoking fresh volatility in equities. JP Morgan's Marko Kolanovic seeing an entry point amid the sell-off, writing something that sounds a whole lot like what he wrote back in June. We believe this is a good opportunity to add, given an expected growth recovery, gradual COVID reopening, and monetary and fiscal stimulus. A trade for the brave, perhaps, at this point. Your team coverage starts right now with Bloomberg's Katie Lyons and Damien Sasser. Katie, yesterday, for those stocks listed here in the United States, brutal.
It was absolute carnage. It was awful, not just here in the United States, but in Asia as well. The Hang Seng China Enterprises Index had its worst day since 2008. You saw a little bit of a rebound in the overnight session, though, and when it comes to those ETFs, you are seeing a rebound as well, though it only goes so far to unwind some of the damage seen yesterday. The iShares MSCI China ETF, for example, up about 2.3%, and the Crane Shares CSI China ETF up 4.8% after having a record day of losses yesterday. Now, you pointed out Marko Kolanovic saying that now is the time to come buy in, and that he also said something pretty similar since June. So just a word of warning on what has happened since he initially made that call about 4 months ago. We saw a lot of inflows into the MCHI ETF, the largest China ETF, in June, record inflows, in fact, and since then, we're down another 35% from there. So that may be why dip buyers aren't all avid this morning coming in to buy those stocks while they are cheaper. There has to be a calculus between risk and reward here as they question whether or not Xi Jinping in his third term is going to have even more market-unfriendly policies. And that concern mostly is showing up domestically in Chinese equities. It's less so in companies that have high revenue exposure to China. An index of those stocks only down about 21%, I say only, over the last year, but that compares to a 49% loss for the MSCI China Index, John.
That's the equity story. Let's talk about foreign exchange. Today in the bond market, monster rally off the back of some weaker data a little bit earlier this hour. House price data in the United States, much more softer, negative than expected. We're down 16 basis points on a 10-year right now. On a Treasury, yields just about 4.1%, just south of that level. On a 2-year, 440, down 10 basis points. And G10, dollar a whole lot weaker against the Chinese currency. Damien Sasser, anything but. That really stands out on a morning like this morning, doesn't it?
Yeah, absolutely. Well, and look, if you're talking about the offshore yuan, that's at the weakest level we've ever seen since it was launched in 2010. If you're looking at the onshore yuan, weakest in over a decade. And the reason that I'm really focused on, it's the basis, it's the differential between the two, because we saw that blow out to something on the order of 570 pips earlier this morning, John. 570 pips, that's 2.5 standard deviations. I mean, that's a huge, huge move. It's bigger than the move we saw in the 2020 VAR shock. So obviously there's a little bit of bloodletting going on here, and what I'm saying is the offshore yuan is leading the way. It's showing that much more weakness over the onshore. What's interesting is if you look at 1 month, 25 delta risk reversals, which is kind of an indication of the demand for protection against continued yuan weakness, we're at a 1.7 standard deviation move. So, clearly, the pain is out there and people are feeling it.
Clearly, the concern is off the back of the events over the weekend, with President Xi doubling down, tightening his grip on power in the country. Is the PBOC going to tolerate this, Damien, given what you're seeing materialize?
Well, I mean, look, the new candidate, Ying Yang, for the PBOC governorship is basically someone who is really not an insider, but, he's certainly a loyalist. I think the real thing is Premier. I mean, we got Shanghai's, former, the one who oversaw the lockdowns in Shanghai. So clearly we're not seeing any pivot away from COVID-0, Jonathan. That's the big story here. That's what markets were hoping for, that you'd see some sort of a shift away from that. You're not getting it, and that's what's leaning on the equity market. This is going to be the first year, by the way, since Stock Connect was formed, Jonathan, where equity outflows, net equity outflows for the full year 2022 out of China. I mean, that's a pretty telling story, I think.
Hey, Damien, thank you. Damien Sasser, Katie Lyons. Allow me to run through the price action of this morning so far, about 23 minutes into this. On the S&P, we're up again for a third straight session, up by 0.8%. Big run of gains here on the Nasdaq, up by 1.5% off the back of a monster rally in the bond market. How many times have we seen moves like this? Big moves to the bond market. Yields down by 16 basis points. Call it 17 basis points lower on a 10-year, down 10 on a 2-year. The data weak in America and the dollar index rolling over. The dollar index negative 0.9%. Up next on this program, your trading diary.
Okay, so you're moving in on me. Quick. Distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I thought Tuesday would be boring. Right now, anything but. About 26 minutes into the session, the dollar's weaker, the bond market's absolutely ripping, yields are much lower, and equities are up as well. Yields down right now on a 10-year by 16 basis points. That's the price action. Here's your trading diary. President Biden speaking at 2 p.m. Eastern, followed by earnings from Alphabet and Microsoft after the closing bell. Meta and Twitter reporting on Wednesday, then it's Amazon and Apple on Thursday, plus a busy day of data with jobless claims, US GDP, and an ECB rate decision. And we close out the week with a BOJ rate decision coming up on Friday. From New York, that does it for me. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
No one covers the world like Bloomberg.
Because Trustonomics is being dismantled, MPs behind the scenes are asking, what's the point of having her at the top?
Can the strong dollar amplify the world's risks of instability?
Xi Jinping said complete reunification must be realized.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrell. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113 also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venegold as an opportunity to leave that troubled home. Venegold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venegold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Gold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Gold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small and space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance, is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is a lot of them are younger investors who are looking to hone their skills.
Tech in right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, The hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a